Bentornati. Dimmi quando vado. Okay, I think you can hear me. So let's start from where we were stopping last time. I'm finishing the lecture about where Bitcoin. So I am recovering some of the parts that I couldn't finish last week, and then we move into the lecture of today, which is the Bitcoin industry landscape, and we try to finish everything in the right time. Today we were supposed to have a guest lecturer. Instead, I'm finishing the introductory part of my course, and then we move the special guest later on. The special guest was Wiz, so the students following from El Salvador, they already had the pleasure to listen to him there, but then he came back to Japan and he was a little bit too jet lagged to move again so early. So we will probably program Wiz visit a little bit further down the line. So last week we were watching this slide, and I skipped the first the covers that I show you in the slide. These covers are covers of Bloomberg. The one is from 2016, and the other is from 2018. And the first one says blockchain in the first cover image. That's an image of Blight Master, which was like a Wall Street lady who basically were one of the first Wall Street personality to try to ride the blockchain hype in 2015, 2016. She created a consortium about blockchain things. Then many other followed, and there was basically a giant empire of blockchain things, blockchain hype. Everybody had a blockchain strategy in a company. If they didn't, they hired people to try to develop a blockchain strategy. And the other one is a more recent Bloomberg Business Week story about crypto. This is from 2017. It's all about crypto here and crypto there. The thesis here, before we enter more specifically into the topic of legal arbitrages, the thing is that usually when there is a new phenomenon emerging, the legacy world will adapt to this new phenomenon in a way which sometimes create a substitute buzzword for the phenomenon. Let me give you an example. In the 90s, there was the internet coming on. The internet was a specific protocol, TCP/IP, so a very clear protocol with some characteristic. At the very beginning, the giants of the telecommunications, they didn't like to accept the internet as it was. They wanted to create some kind of euphemism for the internet. Sometimes I make the example. Let me go to the whiteboard. You know about the 5 stages of loss elaboration by Kubler-Ross. When there is something you don't like a trauma or a loss, first you are in denial, so these things doesn't exist. Then you go to anger, which is basically I will fight these things. Then you go into bargain, so these things will exist but at my condition. Then you do depression, because the bargain failed and it produced nothing. And then you go to the acceptance phase. That's not just true for personal losses, but with all the caveats, because you cannot really create models of human interaction. This also happens with innovation. Usually when something very radically new happens, the incumbents will just say that it doesn't exist and ignore the phenomenon for a few years. Then they will try to write angry letters to the regulators to stop the phenomenon, like this is evil, this is bad. Then they will try to do the same thing, but with a new name under their own control. Then they will go into desperation because nothing worked, and then they will just accept the phenomenon. This happened with the internet, for example. Internet doesn't exist. You can find newspaper articles, and you can find them ironically on the internet, where the journalist is saying the internet was just a fad. It has already disappeared in the 70s. Then there was a phase of anger. There are many, many articles again in which people call for regulators to ban the internet because it's a place for criminals and perverts and terrorists. Then there is the negotiation, the bargaining phase, in which most telecommunication giants, they will say the internet is here to remain, but it's not really the internet. It's more the concept behind the internet, and we are building the alternative. For example, in 1995, Bill Gates published a book called The Road Ahead, and in the book there is a page which says the internet itself is doomed to fail because it cannot scale. It's legacy tech from 20 years ago, but the concept of information superhighway, that's going to remain. And we at Microsoft, we are building one of these information superhighways. That was a term that was actually popularized by Al Gore, and it was reused by Bill Gates. 6 months later, 5 months later, actually, Bill Gates gave a speech called the Tidal Wave speech, in which basically he launched Internet Explorer. And so they changed all the following editions of the book, The Road Ahead. They were modified. The book is still the same, but at that very page, it says, the internet is this information superhighway, and we at Microsoft were building it. So there was a complete 100-degree turn, which is basically the acceptance phase. This is something similar for Bitcoin, and we can see two different kind of bargaining terms. So when you don't want to say that Bitcoin exists because it's still too scary, but you don't want to say that Bitcoin doesn't exist entirely, you try to approximate to bargain by saying Bitcoin no, but something else yes. And in particular, this euphemism is split in two parts depending on the agent. On one side, you have the euphemism blockchain, and the other side, you have the euphemism crypto. So basically, blockchain is the euphemism every time some player needs to make Bitcoin appear less disruptive, more consistent with the regulation, more consistent with the legacy world. Universities, they like blockchain, they don't like Bitcoin. But politicians, public institutions, they like blockchain, they don't like Bitcoin, at least traditionally from 2015. As we discussed the last time, blockchain is just a technical term started within Bitcoin. Satoshi never used the term, but people started to say around 2000, 2012, 2011, people started to say, yeah, did you sync the blockchain? So the chain of proof of work blocks. And then the term just became an image of something that was like Bitcoin, but without all the scary characteristic of Bitcoin. So no privacy, no anonymity, no volatility of price, no investment, no finance. That's scary. That's something that we don't like. So it's just computer science, maybe something that can be used to prove things even beyond any kind of realistic expectation. For example, people started to put like diplomas on the blockchain. Of course, you can timestamp it, you can timestamp it like we were discussing here. So you can put a diploma on the blockchain in this sense. You're just proving the date of existence of the diploma. You're not saying anything about the reality of the school or the content of the knowledge of the student. You just say that one document existed, but you can say nothing about who wrote the document or whether the document contains the truth or doesn't. So blockchain was one of these two euphemism, and the other was, and that's ironic because as we said here, here, actually what we're trying to do now in Bitcoin development and research is try to use Bitcoin without the blockchain. So to minimize the use of the blockchain. You remember blockchain as a necessary evil. The other term is crypto. Crypto is a little bit the opposite in the sense that Bitcoin is scary, is new, is disruptive, is unregulated, difficult to regulate in general, but is also to some degree boring. If you study these price dynamics, for example, imagine that you are an aggressive trader, an aggressive Wall Street hedge fund, and you want to basically do manage wealth management for your clients. The strategy that works better for this kind of dynamics is basically buy and hold, ignoring volatility over a time frame of 4 years or more. You basically go up, you basically skip inflation, which is exponential there, you follow the power law approximately, and you ignore this kind of cyclical noise that you can see. So if you really want to become aggressive and have a very, very strong opinion about the cycle, you can try to sell high and buy low a little bit. But you don't need like a great wealth manager for that. Basically, the safest strategy in Bitcoin is just buy and hold. And there are many examples of how a strategy of just dollar cost averaging will have beaten most of the other indexes that has been used. So the problem with Bitcoin is that if you are a trader, for example, or if you try to sell something, usually, and this is something that we will also analyze during the later lecture about the business models, it's very hard to sell something when we are discussing an open, permissionless protocol that everybody can use with the software that everybody can copy. What are you selling there? The protocol is already there. It's accessible for everybody. It doesn't have any kind of exclusion. So what is your role? So but there is another bargaining term, which is crypto, which sounds way better for especially for traders, technology companies, anything which is related with selling something to the retail, because then especially VC funds in the venture capitalist world, crypto was way stronger than Bitcoin, because in crypto at least you can pretend that you can print a new token that will make everybody rich, and then you print the token, and then the venture capitalists will just dump the token on retail and they will make a lot of money. So there have been this kind of hype cycle in both direction. Crypto is the more aggressive thing, because when the volatility of Bitcoin is not enough because you want to sell even more to your clients, then you move crypto. And maybe you can use a lot of buzzwords like this is like Bitcoin but faster, but more private, but larger, like heavier or lighter or whatever. Quantum resistance, analysis resistant, ASIC resistant, FPGA resistant. This is like Bitcoin, but you don't have environmental hazard or pollution. So any kind of narrative to try to be a little bit more aggressive than Bitcoin. While blockchain is basically Bitcoin voided of anything scary, anything controversial, which seems like just a very neat academic or political computer science research project. This created a lot of noise in the ecosystem, a lot of dispersion of information. Even now, it's very hard to navigate the internet and get consistent and clean knowledge about Bitcoin without being completely overwhelmed by crypto and blockchain stuff. But it also created, and here I will try to. So what I did now is basically the usual case for Bitcoin maximalism. Bitcoin is the signal, everything else is the noise. I will try, though, to make an exception in this lecture to talk about legal arbitrage, which is the point of this slide. I was saying before I closed the lecture the last week, that BitTorrent is a good example of something that created a shield for legal arbitrage. So we say that you have Napster. Napster is centralized. Then the regulators will close down Napster. Then people will create BitTorrent, which is decentralized. There is no single point of failure that the regulators can attack. So it cannot be shut down. And so people gradually will use BitTorrent a lot. But after a while, people will start to use centralized systems instead, because the regulator will prefer to allow a centralized system to flourish because they are a little bit easier to control. So the regulator, instead of having the users go into BitTorrent directly, which is totally impossible to regulate, they will prefer to just leave some centralized platform flourish, because at least they can go there when the legal concern about the content is too aggressive. So they will allow them to violate intellectual property rules, but then they can step in, they can try to mitigate, regulate, negotiate. Something similar happened to crypto specifically, in the sense that Bitcoin became a shield for something that was impossible before Bitcoin. Let's go back to this first slide. You remember here that we say that David Hume tried to do digital cash, so digital banknotes that are just transferable from one bearer to the other, just like cash, but no bank accepted to issue this kind of banknotes, because it was too controversial, lack of control, giving up control on the users, and so on. And so this didn't even start. Now there was e-gold. E-gold was possible to bootstrap because it didn't need any bank. The people from gold, they just put a lot of physical gold in a vault, and they issued notes that were convertible in physical gold. That doesn't need the banks to bootstrap, but the regulator, after many years of activity, shut it down completely. Now, the interesting comparison with Napster is that after this was shut down, people research on reusable proof of work, and then they eventually happened to move to Bitcoin. But and then Bitcoin was scaled up to a lot of different use cases through the Lightning Network and the second layers that we discussed. But now, if there is Bitcoin, and Bitcoin was used a lot in remittances and e-commerce, especially privacy e-commerce, starting in 2013, 2014 already, the regulator will basically lower the pressure on centralized alternatives, because there is a decentralized alternative that the market can basically default to if you stop the centralized one. eCash is not so different from Tether USDT, if you imagine that. So I mentioned I mentioned here the company Tether. What was Tether? Tether was a company created by some American guys that were acquired by an Italian guy running the Bitfinex exchange. Bitfinex was an exchange where you could exchange dollars, US dollars, with Bitcoin. And it was very easy to use the Bitcoin part because Bitcoin is permissionless. But the US dollar part was pretty critical in several ways. Many times, if you were sending wire transfer in dollars to Bitfinex account, they were closing down your bank account, or receiving US dollar wires from the Bitfinex bank account. They were either freezing the amount, or starting an investigation, or closing the account, because it was connected with Bitcoin. So with volatility, with trading, with price bubbles, with controversial technology, with money laundering, bypassing KYC laws, and stuff, privacy, stuff like that. Instead, the company Tether was created to basically represent US dollar notes, convertible US dollar notes, on the Bitcoin blockchain, using a layer called Omni layer. And that was just the idea. The Bitfinex guy acquired this company called Tether, and he tried an experiment. So what if, instead of sending the wire transfer to me at Bitfinex, you send the wire transfer to the Tether companies, which are several companies around the world. They have a bank account. Instead of giving you back Bitcoin, which would be trading, you could have increase of price, decrease of price, capital gain, losses. Instead, you give a dollar, you receive back one note, which is convertible to a dollar. Then the note can be moved on this permissionless infrastructure over to Bitfinex, exchanged to Bitcoin, and back. And this proved pretty effective. So the infrastructure of Bitcoin created a shield, a regulatory shield, to a use case that was still entirely centralized, because the company Tether was a centralized company, just like Napster, and the regulator could ask Tether to stop doing that, just like they could stop PayPal from banking somebody in Somalia. But instead, they don't stop serving the person in Somalia, because the regulator can only act, well, at least currently, on the primary market. So between Tether and the primary market, there is KYC, AML, any kind of regulation, any kind of financial censorship that the regulator will request. But then people will just trade these notes on the secondary market, kind of like we said in eCash. And this secondary market was created on top of Bitcoin. So it was basically impossible to stop. Now, Tether, the company, could issue a note on Bitcoin. The note could go around on Bitcoin, unstoppable. Then the note could come back to Tether, and Tether could refuse to redeem the collateral of the node if requested by the regulator. So there is still a centralization and a trust issue. But at least it created an unregulated secondary market. This is something very similar, in my opinion, to what happened to BitTorrent and to centralized streaming website after BitTorrent. You create the decentralized alternative. The decentralized alternative becomes very, very popular, unstoppable, and then you create basically a legal arbitrage window for the centralized alternatives to flourish for a while, at least, until they get crushed down again. And if they get crash down again, people will move back to the decentralized alternative in a very flexible way. So basically, you cannot go back to the level of censorship you had before. It's funny that Tether didn't just issue the equivalent of e-cash dollars, but also the equivalent of e-gold, which is called XOT, which is basically a note by company Tether convertible in physical gold, which is moved around. Now, it started on Bitcoin. Currently, the use of these nodes is circulating on different kind of Bitcoin clones, so-called shitcoins. The reason for that is that you don't need real decentralization. You just need a credible pretense of decentralization in order to avoid that the regulator can ask you to move around addresses and amounts on the secondary market. You have to say, regulator, I cannot move this stuff around, which is technically true. Tether has no control over Solana, Polygon, Ethereum. Of course, governments could have control over that because usually they are just a bunch of nodes that are completely under the control of very few organizations. But as long as the blockchain hype is covering for these blockchains, there is a very good legal arbitrage window to be used. Now, interestingly, this doesn't only work for notes convertible in US dollar or in gold. Well, just to clarify another thing, BitTorrent was possible to made to be was had been made very easy to use. For example, with Popcorn Time that we mentioned last time, but was still kind of complex. You still had to have a little bit of tinkering with your computer in order to download on BitTorrent, even with very easy clients. Netflix, Spotify, and even vContacti or some random streaming website tends to be even easier. You just go just go on the URL, you close down all the aggressive pop-up advertising, and then you refresh, you close down the advertising, and then you just watch the movie. So it's pretty easy. This is kind of the same. For somebody to understand, for somebody to create a private key, maintain a private key, and then understand these price dynamics and maybe save Bitcoin, protect from volatility, that's something doable. It's something that I will invite everybody to do and to teach others how to do because it's convenient, because it protects you from inflation, and also gives you all the upside of the monetary adoption. So basically the increase in demand, but it's very volatile. So what people are doing with USDT, especially in Latin America or Africa, is just skipping entirely that hard path, and go to the easy path to just have dollar notes that, unlike Venmo or PayPal, cannot be trivially stopped from. They cannot be trivially stopped from using. So once again, if you have no bank identity in Venezuela and you try to open Venmo, that doesn't work. If you just download a random Polygon, Solana wallet and you receive USDT, you just receive USDT. Nobody is stopping you. If you do something particularly visible, then maybe the FBI or somebody else will write to Tether, you, Tether company, are forbidden from redeeming any note which is causally connected with this specific address, because now this address has been blacklisted or something. And Tether will comply, of course, because they are a centralized company. But at least you can use, so it's basically, it's blacklisted and not whitelisted. In order to use PayPal or Venmo, you have to be whitelisted. First, you get an identity in the system, and then you can use the product. In order to use USDT, you just have to be not blacklisted. You have a phone, you download an app, you just use it without any identity. Then, if you are too big or too scary or too problematic, they will blacklist your coin through the centralized alternative. So you can see that this is already a very tempting shortcut. Many use cases that were running on Bitcoin a few years ago, like international e-commerce and remittancy, especially in emerging markets, are now switching to stable coins. That's not something At the beginning was actually surprising for me because it was like, how can you even learn how to use USDT without going through Bitcoin first? And when you go through Bitcoin, you understand that you don't need the dollar anymore because the dollar is heavily inflated and all the problems that we said. Also, you can have censorship eventually. You can have confiscation in the form of blacklisting. With Bitcoin, not so. So you will eventually. So it's hard to go through Bitcoin and then go back to something inferior, which is more volatile and easier to confiscate. But the trick is that people, in many cases, they don't even go through Bitcoin first. They start right away with what they know already, which is dollar. They want dollars. They know the dollar. They would like to use the dollar because they consider that as more stable as compared to the local government shitcoin, and they want that. And Tether or alternatives like, to some degree, other alternatives like Circle, they also give them this kind of use case. Now, as I was saying, turns out that this BitTorrent effect also works with sets, with Satoshis, not just with dollars. What I mean is that if you try to do something completely centralized at the time of e-gold, you will be shut down. So now you have Bitcoin, but what if you try to do a Bitcoin bank right now? Something like eCash, where people will just deposit and redeem Bitcoin from your Chaumian Bank, from your eCash bank. Can you do eCash representing Bitcoin? Well, technically, you could always. Legally speaking, we have already seen in the 90s that if you try to do something centralized, people will shut you down. Well, interestingly, now that Bitcoin exists as a permissionless alternative, a lot of custodial or semi-custodial alternatives started to flourish. Now, many people are using Bitcoin just leaving a third party managing a Bitcoin credit for them. And these use cases are not always censored. They are not always banned or forbidden or confiscated. So it does work, at least for a while. So you can see two different temptations. One temptation, mostly due to volatility and brand recognition of the dollar, is not using sets, but using dollar credit instead. And that's a very common temptation. It's basically a stable coin market. And the other temptation is, let's use sets, but I'm not keeping the sets. I'm leaving somebody else manage the complexity of keeping the sets for me. I will just have credit towards them. This is actually working, and it turns out that in the context of the Lightning Network, which is this network of swooping and routing that you can see in the image above, it's actually very, very interesting to have even inferior security model. What I mean? What I mean is that, let's say that I have to pay. People will not see that from the international students will not see that from the stream. And now I'm pointing my finger at people at the audience here. So I have to pay him, and I'm not connected directly with the Lightning channel or with an ARC. I will have to pay through the routing of the Lightning Network. So I will pay him so that he can pay him, so that he can pay her, so that she can pay him, so that he can pay him, so that he can pay him. Everything is atomic in one single payment. Either it does go or it doesn't go. So this is interesting because let's assume that I have a very secure the Lightning channel with him, me and him, and my recipient has a very secure Lightning channel with him. Even if somebody in between, for example, between him and her, there is actually a channel which is not a secure channel, but just credit. It's just, please trust me, bro, I will give you back your sets. I'm unaffected when I pay, and he's unaffected when he receives. So the interesting thing is that the security, if you have, for example, S paying B through X and through A, the security model, which is between S and A and B, and S and X and B, could be completely different. And I go back to this slide where you can see here different security model. So let's start. This is a security model spectrum on Bitcoin. Let's start from your right. On the right, on your left. On your left, you have full custody. What is full custody? I have the keys, and you want to have a credit denominated in Satoshis, but I keep the keys, I move the UTXO, and you just ask me. You don't have to spend any fees, because if two of you are trusting me as a key holder, so you want to send Satoshis to each other, just tell me. I will change my spreadsheet so that I owe you, if Alice, I owe 10 satoshis to Alice and 20 to Bob. Bob is paying 10 satoshis to Alice. Now I just update my spreadsheet. Now I own 20 to Alex and 10 to Bob. It's done. No on-chain transaction. This is completely off-chain, full custody. Okay, this is very easy to confiscate. The custodian can run away with everything. They can confiscate. They can even change the amounts. They can say, "Okay, Alice, I don't like you very much, and now Bob has more than you. Now all your money belongs to Bob." Now you can move a little bit. This is the model, for example, until a few. This is the model of every exchange. Sometimes you have people paying lunch with Bitcoin Lugano, and they open the Binance app. The Binance app means that they are not moving Bitcoin. They are asking another person, another party, please, you have Bitcoin that are theoretically in my name. Can you pay for me? And the Binance company will say yes. Thank you for telling me through the app. Then there is something like a few months ago, one of the most popular Lightning wallet of Satoshi, was a fully custodial app. It means that you don't have keys that move Bitcoin. You just have keys that sign messages that you will send to this third party, and they will move the Bitcoin around for you. Blue Wallet, when you used Lightning, was also became entirely custodial. People were doing little tips on Twitter or with a bottle. I don't remember the name, but well, basically many other micropayment apps. They were fully custodial. You give Bitcoin to somebody else, and the somebody else will manage it for you. Then you want maybe to get a little bit of security more, not much, but a little bit more. Then you move actually to eCash, to a Chaumian Mint. The Chaumian Mint, the difference that instead of being credit, which is assigned to your name or to your username, those are banknotes that are moving around in a Chaumian Mint. You remember the scheme that we designed about Chaumian Mint. This is a slightly better. Why? Because you have privacy. The Mint doesn't know who you are and how much you have. They cannot confiscate you directly because they cannot even see the amount. What they can do is just run away with the money or do fractional reserve. So the Mint can disappear. The Mint can, when you go back, the Mint can say, no, I don't give you back your sets, but they cannot change your account with somebody else. They cannot step in and move around. It's like you do have cash. It's just that the cash must be redeemed, and now I give you the gold. But the cash is a bearer instrument, is in your hands. The Mint cannot touch it. It's just that when you go back, the Mint can refuse to redeem it. And also they can do fractional reserve. So a bank can just have they can just wallet of Satoshi may receive the 10 Bitcoin, and they issue notes for 10,000 Bitcoin. Why not? You don't even know that Binance or any other exchange are not doing that right now. They could do it. You log in and you see, well, I have 5 Bitcoins, but actually they also printed out of thin air other 5 billion Bitcoins to their own private Binance account, and they are trading and withdrawing and depositing. As long as you don't have the case in which everybody is trying to withdraw contemporarily, you don't have any problem. You can run with the fractional reserve. Then you have something like Liquid. So Elements is kind of a Bitcoin clone which run in a permissionless system. Instead of proof of work, you have people signing blocks with basically proof of authority. And in Liquid, you have the people that sign the block, the company that signs the block. They can run away with the money. They can censor you. What they cannot do is fractional reserve, because in an Elements chain like Liquid, you can run a node that will actually track every issuance schedule, so you know exactly the amount which is circulating in the system. So a Chaumian Mint can inflate the supply. A Elements chain cannot. They can still run away with the supply, though. They cannot rob you personally because there is confidential transaction, so they don't see where the money is, but they can rob everybody. Then you move to a state chain. The concept of state chain is a concept in which you go back basically to reusable proof of work from Alfine. It's the same thing, basically. A state chain cannot run away with the money. They can only double spend some, they can only collude with a double spender. So Alice enters a state chain. Bob enters a state chain. Alice pays Bob. I sign the transfer, but now I collude with Alice to pretend that the payment to Bob never happened, and Alice can go back with the payment originally. I can never run with the money of other people. I can only collude with people in order to prevent payment and to basically unroll to I can basically roll back time, just like Alfine could have done. Then you can move to something like Arc. We already discussed it. In Arc, mostly I'm the coordinator. I cannot run away with the money. I cannot confiscate. I cannot change your accounts. I cannot help you double spend. The only problem is that in order for Arc to work economically, after a few weeks, you have to be online. If you're not online, I can run away with all the money. Then you have a lighting channel, traditional one, Driapun channel. In this case, if I am the central LSP, lighting service provider, like Phoenix, which is a central point with all the channels, with all the people, if you are not online, I can try to double spend. So if you are not online, I can broadcast a previous state of the channel instead of the last one. So you see, there is a gradual increase in security, and then you go on chain. On chain, when you have the confirmation, there's basically nothing you can do. Of course, you can use hash rate majority to reorg the chain and double spend, but that will cost you a lot. And the more confirmations I have on the transactions, the more you will have to spend in order to roll back the chain and reorg. So interestingly, you can have a Lightning network which is not just made of the last Driapun channel type, which was the Lightning network we had a few years ago. Now you can have a Lightning network where all the security models are scrambled together, and people basically can ignore the security trade-off because the routing is atomic. So as long as I'm comfortable with the security model between me and my peer, everything else I can ignore it completely. So this is not just theoretical. There are actually many product using it. For example, Xiaomi Mint. If you use the wallet, Minibits, Minibits for small payments, they will default to eCash notes. So Xiaomi Mints. Fedi, actually, the wallet Fedi, it's a wallet that will just you will pay each other via Lightning. But if you are in the same Fedi Mint, so federated mint, it's a federated Xiaomi Mint. If you are on this, so Alice and Bob, they are in the same mint. If they pay each other, they give each other a Lightning address or a Lightning invoice. But what happens under the hood is that they just pass to each other a Xiaomian cash, like in eCash in the 90s. If they are in different mints, then the mint will basically pay Lightning to the other mint in order to swap the ownership of the asset. That happens with Minibits, with Fedi, and a few others. Now, Aqua, if you use the wallet Aqua, you pay Bitcoin or USDT, but we will talk about that in a second. If you pay Bitcoin, you pay via Lightning. But keeping up a Lightning channel is kind of complicated. So Aqua, instead of keeping up a Lightning channel, which is complicated for you to do in your phone, also there are trade-offs in managing the channel. Instead, your Bitcoin amount, your SAT amount in Aqua will be kept in liquid, which is an elements chain. And when you pay, a service will atomically swap between your liquid amount and a Lightning invoice. So some merchant will show you a Lightning invoice. You have liquid sets. You pay from liquid chain, and they swap automatically to a channel, to a channel, to a channel, and they arrive to the merchant. If the merchant is using Aqua, of course, you are swapping between liquid and Lightning. Then you hope, and then you swap back to liquid, and the merchant is receiving on liquid. Other wallets that work like that are like Bull Bitcoin. They also have a liquid. They also have a liquid layer underneath. Then there is state chain. For example, Spark, the company Light Spark, is pretty famous, pretty aggressive right now, and they are using a protocol called Spark, which is a state chain. So the Spark server cannot steal the money. They can only collude in order to reorg the time, to roll back the time. So they cannot escape with the money. They can only reverse time and then escape with the money if they collude with somebody, but it's not directly, at least. They cannot run with all the money. Spark, for example, used by, I think that it's used now by Blitz Wallet, there is Spark integration. Wallet of Satoshi, that used to be completely custodial on that side of the chain, is now using Spark, and many others are using Spark. And then there is Arc, of course. Arc is actually something that could be that we are shilling a lot, because it's easy to have a wallet which is way more secure, but with the same UX of the previous example. If you download right now, if you go to arcade.money, it's a web wallet where you can go around for Lugano, and you can go around Lugano and pay with sets. The money will stay on your ARC, but as soon as you pay, the ARC will swap to a Lightning channel and to another Lightning channel, or to Liquid, or to something else, or to a chain. Another state chain, if you want to try, is called Mercury Layer. Mercury Wallet is another wallet using a state chain, which is different from Spark, is another one, but it's the same concept, the same security trade-off. And then if you use Phoenix, for example, then you will just create, for every time you receive money or you spend money, you will use Driapun channel to the Async company in France. So that will be pure old school Lightning network. But the real Lightning network is all interconnected. I can have Async, I can Phoenix. I want to pay her. So what I do is I pay on my Lightning channel with Async. Lightning will pay on Liquid to him, and he will pay on Arc to her. And that works seamlessly because of the atomic routing. Now, of course, if you have assets that are not really big, you are not in with the left part of the spectrum, you are not really moving satoshis. You are moving Satoshi denominated credit. So much so that many of these protocols allow users, of course, to issue and to move around something which is not really satoshis, but is everything else. For example, Cashu is the software that allows you to issue eCash notes. You can use that to issue satoshis, credit in satoshis, or to issue dollars, because it's or tickets of a conference, or everything else really. Same goes with Liquid. When they created the Elements chain, you cannot just move around Liquid Bitcoin, which is basically the credit that can be converted back to actual satoshis. But you can move around any kind of asset. For example, the company Stocker issues stocks and bonds and basically financial securities on top of Liquid, and there are many USDT on Liquid. Liquid is a chain which is used a lot for USDT and things like that. So much so that in Aqua wallet you can also move around USDT. Also Spark, which is managing a state chain, they are trying to make now a deal with Tether to issue USDT directly on Spark. And Arc, they have Arc Labs, the company here. They have a protocol called Arcade Assets, and they can issue any kind of assets. And now the only part so the first protocols to issue money was an on-chain to issue credit, to issue any kind of note, was an on-chain protocol, like the one I mentioned before, Omni. Other names were Counterparty, Colu. There were many experiments back then. Maybe you heard the new version of these experiments that are called ordinals or stuff like that. This is a very very out of date way to issue assets, because you inherit all the problems of the blockchain. So your asset will have a problem of scalability. For example, you will not be able to transact very fast. It will be expensive if many people will use it. You will have all the problems with privacy, even worse, because in Bitcoin you already have a problem with privacy, because everything in Bitcoin layer 1, everything is public. So people can try to do de-anonymization. With assets, that even worse, because you will have a smaller liquidity, and so it will be trivial to de-anonymize you if you use assets. So assets on chain, they tend not to be used a lot, and people use asset a little bit on Xiaomi Mints, on Liquid, on Spark, on Arc. But this symbol here, this RGB symbol, was basically the symbol. Now the symbol, I think, of the consortium is this one, but this is the old nerd symbol of RGB. RGB was an idea of mine, coming from an idea of Peter Todd, to basically do a protocol to issue arbitrary assets on top of the Lightning Network. There are many things to say about RGB, and if you end up doing the assignment for RGB for Bitfinex, maybe you will study the protocol more in depth and you will understand more about RGB. But long story short, RGB is basically assets on Lightning. Worst case scenario, they can also go on chain, but they still use the Lightning Network to send some information around. So it's basically there. Now, there is a lot of confusion here. Uh, if you don't feel confused by this, you should. Users are confused, even industry leaders are confused. Everybody's running around trying to create some kind of order in the chaos, but it's still not trivial how to do that. And this is not new, this is not unprecedented. And again, it goes back to the very early days of the internet. This is a picture taken by developer Alekos Firini and sent to me via Telegram from the Museum of Computer of San Francisco. And you can find this T-shirt by the company Cisco, which was printed in 1991. Cisco was flexing the fact that they were supporting not just TCP/IP, which is the internet, but many, many, many other clones or alternative versions of the internet. DCNet 4 and 5, Novel IPX, Apple Talk 1 and 2, ICO, CLNS, which is the Aussie system, many, many, many others. So what happened? People had different kind of computer networks. So people came up with the idea to create one single network of the networks. But this, of course, is a very sensitive thing from the commercial point of view because incumbents, they don't want to use an open standard. They want to force users in their proprietary standard if they can. So one move is to resist the open network. No, stay with me. When you give up, so that's basically the anger phase of your reaction. If you fail resisting the users from leaving your proprietary network to go to the open network, what you do is you try to recreate another open network. So you say, okay, you're going away from my walled garden. Don't go in the open network, which is the internet. Stay in my version of the open network. So instead of joining the internet, Microsoft tried to recreate the internet with MSN. Apple tried to recreate the internet. The regulators, the body, the standard organization, the International Standard Organization, they tried to recreate the internet with CLNS. Xerox, Intel, IBM, they all tried to recreate the internet. By 1991, everybody had their own version of the internet. And Cisco, which is basically a technology company, hardware company, they were doing routers and stuff like that. They were flexing, they were proud to say, we support everything. 4 years later, all this network disappeared except for the first one, the actual internet. Because you can imagine that the value of the internet is that everybody is on the same network. So you don't have the problem of the coincidence of ones. You don't have the problem of the power law of the different combination. You remember the Metcalfe law with all the polygons. So if you have many networks, that doesn't work in compatibility. If you have one network of networks, that works. If you have many networks of networks, everybody trying to recreate it, it doesn't work. So at the end, the first mover, as long as it's open and good enough to work, the first mover will always have a very strong advantage. Usually you have, let's try to do this. I'm going a little bit slow, but actually I'm injecting in this lecture a few elements of the next lecture. So I'm already preparing for that. So if you have an open standard, this is time. Let's say that this is the number of users, more or less. The standard will start very, very slow, and then we will pick up with something which I used to say is an exponential, but actually discussing with Professor Santostasi, in many examples, this is a power law with the exponent of 3. So the third power of time. So it seems like an exponential, it's very similar, but it's not. It's a power of 3. And when this starts picking up, this curve grows a lot. Now, if a new protocol starts here, if it's an open protocol, will still grow with the same rate. Even if it's slightly better, it will still grow with the same rate. So it will never keep up, because they have to basically have the same curve here. So it's never going to match. Remember that the utility of a network is that everybody else is already on the network. So you cannot use the network just waiting that in the future somebody else will be there. Everybody's here, and you are never going to catch up. What you have to do is to take shortcut. You want to grow faster than power law. You want to grow exponential. You want to grow very, very fast. You want to do like this. And there is only one system that grows as this, which is not an open standard, but is a company. You need the marketing department. You need to do to do a partnership with Microsoft. You need to have a regulator enforcing your protocol. You need to have a shortcut, which is being centralized. And that's why all these other, that's why most of these networks, they were trying to catch up with TCP/IP, and they were heavily centralized because they needed to boost. So one of them were enforced by government, one of them were supported by the marketing of a company, many of them actually, and they were very centralized as a result. They were not a common standard. They were open but proprietary in nature. Same goes with cryptos and cryptocurrencies, same dynamic. So what we have now is that on one side, we have incompatible standards, not only between Bitcoin and all the other Bitcoin clones, all the shitcoins. Also, mind that, or going back to our first lecture about the nature and the utility of money, consider that while a Bitcoin world may work, a cryptocurrency world will not work for at least two main reasons. First reason is scarcity. We say that in order to have money that you can use, you need scarcity. You need the fact that if there is an increase in demand, you don't have a corresponding increase in supply. Gold is okay with that. Sats are good with that because you have the halving and you have the difficulty adjustment. Cryptocurrencies are not scarce. As long as there is demand, everybody can create new cryptocurrencies. In many cases, other cryptocurrencies by Bitcoin, they have an internal supply flexibility, like Ethereum. If there is more demand for Ether, they can change the supply. They did it all the time. In Bitcoin, you cannot. But even if it's not internal, there is an external supply increase. If you have more demand for crypto, people will just create more crypto, and you can create infinitely many crypto. Bitcoin is scarce. Crypto is not. Of course, any arbitrary selection, you can say, yeah, but Bitcoin plus Litecoin is scarce. Yeah, sure. Or Litecoin plus, you can create any combination. But usually the market goes with simplicity. The Schelling points in the market, they tend to be very simple. So Bitcoin is scarce, the rest is not. Also, there is later on, this chapter of my lecture is called Internet of Money. Internet of Money is the title of a book by, again, educator Andreas Antonopoulos. I translated in Italian that book many years ago, and many articles that they were very, very good and very, very smart. I will actually suggest you to read it. But one article was particularly impressive to me because it was dumb. Andreas is smart, but the article was very dumb. And it was basically, after Bitcoin, now that we have Bitcoin, we will have a future in which everybody will be able to create a coin in order to transact anything. So Bob is at school, is very good at drawing comic. He will issue Bob coin so that people can buy his comics. And so for everybody else. And then while I was translating, I stopped to think a little bit, wait, this has a name. This is called barter. This is a system in which any kind of good or services is associated with a form of money. So you don't have money, you have barter. You have any goods or service which is represented by a token. In order to exchange, you have to have a market pair and liquidity across any token to any other token. So clearly, cryptocurrency violates the idea of scarcity of Bitcoin because you have infinitely many, and violates the idea of convergence of money over one single medium of exchange because you have infinitely many. So there are incompatible standards across several so-called cryptocurrencies and blockchain, but also, as we have seen here, within the same system. Even within Bitcoin, you have different degree of security of Bitcoin. You have purely trusted Bitcoin credit, or you have trustless sats on chain, or you have trustless sats on Lightning channel as long as you don't disappear, because otherwise you can be double spent. Or you can have trustless sats on Arc as long as you don't disappear, because in that case they can take it. Or you have trustless sats on Mercury or Spark, where even if you don't disappear, the coordinator can still trick you by reorging the chain. So you have many degree and many and a lot of chaotic things. And the last thing I want to mention, in order to increase the level of confusion before I move to the last chapter of this last lection, is the concept of stable sets. One company, actually, to tell you a personal story, our company back in 2016, Blockchain Lab in Milan, we were doing proofs of concept for a bank, for an Italian bank, and we created the very first um, uh, proof of concept of the Lightning Network with Tadeusz Dria and Joseph Poon, the Lightning Labs guys. And we also created another network that I called Gravity Network. That was basically the idea to have a stable coin. Well, it was not called stable coin back then. It was before USDT became interesting. The idea was for volatility, we can do, instead of channels made by two people with two people, we make channels created by three people, two out of three signatures. Two people are the peers connected to the channel. The third signer is the oracle of the price. And the idea is that if I want stability, I put one Bitcoin on the channel. You put one Bitcoin on the channel. I want to be stable. So if the price of Bitcoin goes up, the oracle will sign for me to exit the channel with less because now Bitcoin is worth more. And if Bitcoin goes down, the oracle will co-sign for me to exit the channel with more. So basically, the third signer, we're allowing this kind of future contracts on the price of Bitcoin, which were not trustless because you still have to trust an oracle, but you don't have to trust your commerce counterparty. After many, many years, one company created this. It's Galois. It's called stable sets. Stable sets are dollars, but they are not credit that the company Tether will convert for dollars. They are sets, but they always correspond to the amount which is equal to $1. So you put sets on this channel, which is worth $1. If Bitcoin goes up, you will just have a right to half of the channel. If it goes 100% up, if it goes 50% down, now you have the right to double your portion of the channel. Of course, there are a lot of challenges in this structure. I mentioned it in the lecture because one of the assignment by Galois, for the ones of you that are doing the assignment with Galois, could be on stable sats, or so it seems. So this is interesting. But I put it as an example of the chaos, because now you have a different way to do assets on Bitcoin. You have different assets across all different second layers. And you also have the idea that one asset could be represented by actual collateral that can be modulated by an oracle. So it's very messy. So let's go to the last chapter of this lecture. Again, I'm going slow because I'm anticipating a lot of the things I was supposed to say later, which is Web of Trust. In the 90s, actually late 80s as well, there was but mostly in the 90s, there was an experiment among nerds, which were called Web of Trust with PGP. PGP is a protocol that means pretty good privacy. The idea is that you have a public key, you have a private key, and you can use asymmetric cryptography to encrypt messages and decrypt messages, or to sign messages, or to verify signatures of messages. So it's typical public key stuff. This was way before Bitcoin, and there was a grand vision that this protocol could eventually allow something like that, something like a web of trust, an internet where everybody either knows somebody else, so I can trust you, or knows somebody else that knows somebody else that knows somebody else, just like that Lightning Network, but in terms of trust. So the idea is that we don't know each other physically, so that we cannot hurt each other and we can have crypto anarchy. But we know each other because I interacted with you. You sent me the product that I wanted at the right price at the right time. So you respected our contract. So I will create a public message signed by my private key saying this guy with this public key was honest. And the idea is that everybody that trusted me will have an indirect trust score with this person. So, for example, you have Susie. She trusts Manfred, and Eve also trusts Susie. So Eva is indirectly trusting Manfred as well. So this is a concept of web of trust. They needed to develop this mostly because in the cyberspace in the 90s, there was no Bitcoin. So you could not pay somebody. You just have to trust somebody. So scaling trust was particularly important. It didn't work out. I mean, you can still go to a key signing party with nerds. That can happen, and you can still. That's useful. Bitcoin developers usually they will show you their fingerprint of their public key in the presentation, so you can trust them. There are many things you can do with keys. For example, there is delegation. So I sign your public key with my private key. So that's the delegation. There is key rotation. So now I have a new public key. There is a revocation. Guys, my private key has been compromised. So I sign a message that says that you should not use this public key anymore. And there are all these kind of features inside the protocol. It's a very advanced protocol. There's another thing which is called derivation, which is very important. Instead of running around with 100 keys, private keys, I create one key, and this key can be derived from this key. I can derive 100 different keys. So I just have to remember one, and from that one, I just apply a little mathematical trick that will derive everything else. This is actually the way that Bitcoin keys work. You don't remember you don't have the key for every UTXO. You have one key, and your wallet will derive one derived key, one child key for every single UTXO. So this was a grand vision to make the internet trusted even among unknown parties, but it didn't work out. At least not outside a very small bubble of nerds. The idea is that maybe right now, in the next few years, and the reason I put it in this part of my lecture is that I think that some of the projects you may be working on, some of the companies you may be working on, may be connected with this huge challenge, is to leverage the fact that now incentives are different. In the 90s, storing a key was something very technical, very difficult. You had to be able to do that. What you could learn, I mean, we learn how to write and read, which is very complex. We learn how to drive, which is complex. So we can easily learn how to create a store 24 words, it's not, or 12 words. It's not that difficult. But the problem is that there were no incentives to do so. What happens to me if I learn how to do key management? Well, I can sign messages to nerds. Okay, but there was no real demand for that. Now, incentives are completely different. What happens if you don't learn how to store securely 12 words? You do lose money. So, money is a stronger incentive than either privacy or security in communication. Security in communication is okay, but talk is cheap. Also, people back then didn't have the challenges we have now with like AI fake in voice. So you get an email with somebody which is called John Smith in the early 90s. It's probably John Smith. People didn't even figure out how to spoof, let alone how to do complex catfishing or very complex Sybil attacks and stuff like that. Now you can receive an encrypted message on WhatsApp with signed by a private key, which will send you a vocal message from my voice asking you to send Bitcoin my way because I had a tragic boating accident. It will be my voice, and it will be very good. Why? Because there are many videos of my voice around, so you can easily train a model to do my voice perfectly, even in the mistakes, even in mispronunciation. Everything can be perfect. So you can receive a very long message from me. Well, if it's very long, usually it's me. But if it's not so long, it's usually a scammer that will just ask you money or to invest in a new token. So now, in order not to be scammed in a more advanced way than the 90s, and in order not to lose money, people finally have the incentives to use keys. You have people that will have never even dreamed to use PGP in the 90s, and they bought an hardware wallet for Bitcoin. The second change is hardware. The only way to generate and store and use a key back in the 90s was a computer, like a personal computer. Not easy to go around with that. Now, not only you can do that on cell phones with some level of security, because many cell phones, they also have secure enclave, which just like you remember Hal Finney and his server, secure enclaves are parts of the phones where the hardware producer is basically asking you to trust them, that nobody can read the private key inside and it can sign for some things, giving you some kind of guarantee. If you trust the hardware producer, of course, which you shouldn't, but in general. Now we also have, so we have that kind of security on phones, and we have the hardware signers. They are called also hardware wallets, or Bitcoin signers, machines that create, store, and use cryptographic keys in a very secure way. What is the difference between, that's a cold card queue? What is the difference between that and a phone? Well, the phone can be attacked. Your neighbor will take your phone, and they can try to extract every secret which is inside. Maybe if it's in a secret enclave, it's hard, but there is always a way to do it, or put keylogger or everything else, side channels attack. That stuff is created on purpose to be very hard to hack. So you can trust that probably if you have your keys in these, maybe the cold card producer, CoinKite, they may backdoor you. That's not impossible, but your neighbor will never extract money from that. Even the Ledger Nano S, which is a very common crypto wallet, if you leave a Nano S around, your neighbor, your hacky neighbor, will never be able to extract your money. Now, the Ledger company or the French government, of course, they will be able to, but not your neighbor at least. So it's a different kind of trust models. There are, I put here a very pricey model, which with two different secure elements from different products. So the idea of CoinKite is you don't have to trust me. I'm using chips produced by other two companies, different among themselves, plus my own chip MCU. So you don't have to trust me alone. You have to trust that at least one in over three companies is honest with you. That's very pricey. It's very, I use it especially because of the key derivation is very comfortable. But there are other that are like our friend Alekos is doing Portal, which is an experiment of a few years ago of a NFC mobile first wallet, which is very cheap. And then you can do Seed Signer, which is a hardware wallet that you can just build on your own with a very different security model with off the shelf commodity parts. So there is a full range of things. Now, the nice thing is that even from the point of view of mainstream fiat normie things, security of keys is starting to become slightly better than it was in the past. Typical mainstream services, they used to be username and password. So username, your name, password, 1 2 3 4 5 6 7, or your pet name, and then you write your pet name on the post-it and you put it on the screen of the computer. That's maybe funny for you because you're a little bit better, but you have to know that there are countless business and government offices where this is happening even today. Now we have stuff like Oath, which is more known as passkey, which is basically the idea that now it's still not great, it's still not very open, permissionless, and it's still dangerous from the privacy point of view and the permissionless point of view, but it's starting to become a little bit more reasonable. So now Google is basically telling you, instead of memorizing a password, which will be usually very, very low security, and then trusting that when you write down the password, the JavaScript of the website is not actually pawning your password, what you can do is generate the private key on your phone locally. It will be generated on a little enclave, on a little part of the phone that, trust me, bro, is something that nobody can break and is not giving us any copy of the private key. Then when the key is generated, this key will not sign for everything. This key will only sign from the phone. But then you do basically a federation of key. That means that when you open the same application from your laptop, instead of moving the key around, writing down your password, you just ask to your key on the phone to delegate the key on the laptop. So the laptop will generate a QR code, one off. The phone will scan the QR code and they will confirm, yes, this is still me. So now you have two keys. One is generated by the phone, one is generated by the laptop. And they are just federated because you said with one that the other is still you. And then people can have, think also about the backups. The backup plan becomes simple. Instead of backing up your key, as long as you have at least one device which is surviving, so I lose my phone, well, I get another phone. From this phone, I redelegate my phone that I've lost. Of course, this has implication about security. If you steal my phone, now you can delegate my keys. So there are a lot of thresholds to do, a lot of there are a lot of consideration. But my point is just that even normies are, for the first time in decades, taking key management seriously. So maybe now is the point where there is a realistic challenge ahead of us in order to actually create a working web of trust around Bitcoin. Let me move to the point of invoicing. I said before that, I will say it again because it's an important point. So at the beginning, Satoshi was using pay to IP. So pay to the IP address. P to IP. So I call the IP of your computer, the IP of your computer responds, they generate a private key, they derive a public key, the computer sends to my computer a public key, and I pay to the public key. So this becomes pay to public key. But then this was not safe, this was bad, man in the middle, no privacy, easy censorship from the ISP. So Satoshi moved to pay to public key hash. I just create the public key on my computer, I hash it, I give you the address. But this was not flexible at all. What if I have to ask you to pay to a multisig? I have to send you not just the hash of the public key, but all the smart contract, which is also bad for privacy because now you that are paying me, you know about my private smart contract multi-sig configuration. That's not good. So we move to pay to script hash. So I create a smart contract, multi-sig, time lock. I hash the smart contract. I give you the hash of the smart contract, and you pay to the hash. And then when I have to spend, I will reveal the hash so that everybody can confirm that the smart contract is good. And now, after this, we move to pay to taproot, which is instead of the hash of the script, the Merkle root of the script. So I can select individual parts of the smart contract, which is more efficient and more private, and it's better. So these are the addresses starting with, well, these are not addresses, these are IP. These are the addresses starting with 1, these are starting with 3, and these are starting with BC. Now, in Lightning, you don't use these. In Lightning Network, you use Lightning invoices. We start with LN, and they're very, very, very long, very, very, very long. And when you go in Lugano, and the Lugano merchant will show you the payment invoice, it will not be an on-chain address of either type. It will be a Lightning address. The idea is that now many standards are developing in order to make this Lightning address as flexible as Satoshi intended with the initial payment protocol back in 2009. For example, why should I just tell you, pay me this? Maybe I want to tell you, pay me this, but please, you have to do that from three different outputs. Or please, I have one output, mix your input with my input so that we do a coin join, which is a way to do a transaction together to increase privacy. Or we do a pay join, which is a coin join in which you pay me. Or please, before you pay me, I want you to do 3 transactions on 3 different transactions. So I want your key to spend another key to another key to another key, and only then you can spend to me, because I want, for example, to avoid censorship or blacklisting or something. Or don't pay me, for example. I am a group of friends. I'm part of a group of friends. We gave you a service. If you pay me, I want one of each of my friends' addresses in one single payment. So instead of you paying me and then I make a payment to 3, I want to tell you to make a payment to 3. This should be all automated into one single payment protocol. And the nice idea is that the Lightning Network had a few problems because the very first invoice of Lightning, called the Bolt 11, BOLT 11, they used to be ephemeral. So I want to be paid, I create it, then you pay me, and then you cannot use it anymore. They were one use. And also it usually has an expiration date. If you wait too much to pay me, the invoice is expired. That's a bad UX, because sometimes like Luca wants me to pay, and then I wait 2 days, I try to pay, oh, this is expiring, can you send me a new one? This is very annoying compared to, for example, the traditional Bitcoin on-chain address. The on-chain address, you generate it. That means that you have the key. It stays there forever. I can pay forever. Instead, Lightning Network invoices are one single use, and they are basically they expire. So people, actually the same investor of Noster, Fiat Jaff, a few others actually, came up with the idea called LNURL a few years ago. LNURL is a URL, so a server basically on the internet, that I will not give you a Lightning invoice. I will give you the address. You connect with your wallet to the address, and you ask me, please, to generate an invoice. So LNURL was a technique that instead of sending you this invoice, I send you to a website that will generate invoices from me automatically. You don't even have to see it. Your wallet will do it automatically. But then LNURL expanded a lot, and you started to have LNURL out. So, for example, a way to log into website by using your Lightning wallet. And there are many wallets where you can log in by using your Lightning wallet because you already have the key, and they're using LNURL to connect. Then there was LNURL withdrawal. I'm asking, so for example, there is a treasure chest. You go there and scanning the QR code, instead of paying, you get the money. So the first to find this QR is grabbing money for the wallet. It's the opposite of a payment. You are basically receiving a payment. You can have donation. You can have you put so for example, you say on your blog in 2009, 2010, people used to put a on-chain address on their blog, donate Bitcoin here. That was very, very bad, because now there are copies of those pages, and you can track on the blockchain each single flow of satoshis across these addresses. Now with LNURL, you put the LNURL there. It's still the same, and people will connect and pay you off chain, and nobody will see your history of payment. Good privacy. Here in Lugano, the blue points of sale will not do that. But if you go to Spar, which is a supermarket here in Lugano, you go there, you will see a printed QR code. So not a screen, a printed one, which is all the same next to the cashier. So you go there, you scan it with your phone, and it says no payment active. Now the cashier will introduce your payment after you did shopping. Now you go to the same QR code, and they will generate instantly a payment with you. And since it's LNURL, which is a standard, every kind of, you try to pay that with Phoenix, with Arcade, with Mint, with Fedi, with every wallet you try to pay, since it's a very good standard. Almost everybody now understands LNURL, so you can pay. It's even better than that, because if you try to pay with some shitcoins, including, I don't remember how many, but a few shitcoins or USDT, the QR code will automatically recognize your wallet. So when your wallet will connect to the website, to the server will ask you, what kind of wallet is this? Okay, you are paying with Dogecoin, Shiba Inu, whatever. I can still accept that. They can accept everything, and they will do the conversion. That's pretty neat, not just for Shiba Inu, because nobody pays with Shiba Inu, but mostly it's neat because of USDT, because people will pay with USDT in many, many economies. The problem with LNURL is that you need a server, and people are not good at running servers. I don't know how many of you in this room have servers running at home. Not many, probably 3 in this room. Running servers, you have to do Nginx, you have to do reverse proxy, you have to keep it on, you have to have electricity, good internet. It's hard. So what happens? That nobody wants to run an LNURL server. Normal user will not. So every time they run LNURL, they will still delegate custody to somebody else. They will tell you to pay somebody else that will then maybe pay back to you some credit, which is not good from the point of view of security. So developers came up with Bolt 12. Bolt 12, or another funny story, Bolt, basic of Lightning technology, is the new name of what was called Protocol Milano, because it was created in our office of Blockchain Lab in Milan in 2016, because initially all the implementation of Lightning Network, they were using different standards. So you could do Lightning, but the Lightning of Blockstream was not hopping in the Lightning of Lightning Labs, which was not hopping in the Lightning of Bitfury, or in the Lightning of Amico Pay and others. So what we did was basically kidnap developers and shutting them in a room in Milan, providing only pizza and oxygen and light, and that was the only kind of nutrition. And they came out, they could not exit until they were all on the same protocol, and they came out after 3 days with the Milano Protocol. And the Milano Protocol was renamed BOLT, Basic of Lighting Technology. BOLT 12 is a way to have something light like LNURL, but without a server. So your lighting application will be able to create a static invoice that can receive donation, negotiate a lot of things without using a server. Of course, somebody's using Bolt 12, so there is still growing, is not yet a universal standard. Of course, technology to show the invoice to each other is also changing a lot. For example, the SPAR technology that I showed to you uses QR code. Here in Switzerland, QR code is very big. People like QR codes. There is also the local system to pay here. Twint uses the QR code. You can use QR codes in the parking lot. So it's very big. In other, like in Asia, there are entire parts of Asia where QR codes are very out of fashion, and you just use contactless NFC. And so there is a standard of how to represent your node so that somebody can reach out to your node and pay you. And then there is a standard of how you communicate this visually with QR code and cams or with NFC. One is close proximity, the other can be done remotely. QR codes are fine because, for example, right now there are a few countries, also in Thailand and in Korea, where you can actually have system where you have to pay, you show the QR code on the system. Some other Bitcoiners in any part of the world will be able to pay fiat to the QR code, and then you unlock the Bitcoin in escrow. So you can, so let's say here in Lugano there are parking lots with a QR code. They don't accept Bitcoin. The QR code is fiat. So I can do an app where somebody else can see I will lock my Bitcoin in escrow. Somebody else will see the QR code, pay fiat, and when the fiat system release the payment because it happened, they will release the Bitcoin back to the person that paid. So we can do very funny stuff like that. It's happening right now all over the world. There are different systems to do that. That's possible with QR codes. That's not possible with NFC. So there are a few issues with that must be addressed. But NFC are very, very comfortable. Now, another example of Bitcoin stuff which is generating a new web of trust, it's Nostr. Nostr was created by the same guy that did LNURL, and this is the idea that you can have a microblogging, basically like Twitter, but done with private and public keys. So instead of using Twitter servers, you will just sign notes with private key, and you will use public key to recognize each other. And then you have realized that there are servers that will collect and relay all these notes so that everybody will be able to communicate with everybody. Nostr is cool, but it doesn't really work very much. I mean, you can try Primal, you can try Iris, you can try many, many things. It's very cool. The problem is that it's facing a lot of technological challenges. So some people are trying to go even more radical because Nostr uses the internet. So you sign notes, you use public keys to recognize each other, and then you send notes via internet, via JSON. So let's try to put it this way. You have a technological stack. Let's change color because this is becoming messy. So you have internet protocol, IP. This is the way that internet packages, yes, are created. On top of that, you have TCP, the transmission control protocol, where you create virtual networks to be more efficient, a little bit like the Lightning Network on top of the Bitcoin network. Then you have HTTP, where you have hyperlinks and the URLs and everything like that. And on top of that, you have an application like Twitter. I know it's called X now, but I will still call it Twitter. It's nicer. You have Twitter. So this is a typical stack structure of the internet. This, there is just one of that. Every alternative to this failed. Everything converged over one internet protocol. Internet protocol was ossified. It means that it didn't change for many, many decades. It reached version 4 in 1994, in 1984. It remained the same until basically a couple of years ago, in which version 6 started to spread a little bit around. But it didn't change for decades. So the internet changed a lot in the last 40 years. But the internet protocol basically never changed. There is one of it, so it's convergent and it's stable. It doesn't change. TCP, there are many alternatives like UDP. Well, many. There are 3 or 4 alternatives, and it changed a lot more. It changed during the 80s and during the 90s. HTTP, there are many alternatives like email is SMTP or FTP or many. There are many alternatives, and it changed a lot. Recently, there was a big change in HTTPS, and there are many changes. On top of this, there are standards like JSON, which are completely new. Twitter has many competitors, like whatever, Blue Sky, Threads, Facebook, many competitors, and it changes a lot. And every few months, the algorithm will change, the rules will change, and so on. So the more you go up in a layer scale, the more you have competition and you have evolution. The lower you go in the technology stack, the more you have stability and unity of protocols. This is trivial in other things as well, like other human institutions. The base layer tend to be one and stable. The upper layers are many and competing, and they change. Nostr is trying to replace Twitter by building on top of HTTP. So it takes HTTP and it rebuilds Twitter here, Nostr. There are others that say, well, let's get away with HTTP because there is no privacy. You cannot build a mesh network locally. There is no resiliency. It's all captured by ISP but also by ECAN and DNS services that are centralized. Let's get away with TCP because it's also bad. Let's rebuild an entire new internet. And that's, for example, well, that's not coming up very nice. But that's an example of the pairs. So the technology of the company Hole Punch, which is the producer of the communication app Kit, for example, is if you go on pairs.com, and the company Hole Punch will also probably give you some of the assignments, so they will be also part of your assignments. They are trying to rebuild an entire internet from here. And an example of that is the application Kit. Of course, this is a little bit more ambitious than Nostr, but it could work in a little bit more ambitious way to replace entire parts on the internet stack in order to allow for mesh networks, more privacy, a rebuilt bottom up of the stack. So there are all these together. My thesis here would be that all these together, recently there was BitChat. So, Nostr was created by this guy, Fiat Jaff. I joined it many years ago. Nobody else cared. Then Jack Dorsey put a lot of money on it. So it became famous, and so many Bitcoiners started to care. BitChat is a vibe-coded mesh network app. There are dozens of mesh network apps. Mesh network means that I have a phone, you have a phone, there is no internet, but we have Wi-Fi and Bluetooth and other short-term communication. So instead of just going through the internet, we can communicate locally. That doesn't seem exciting, seems like a walkie-talkie, but the main idea is that if you are connected to the internet, I am not, I can route through you. And so if we try to take down the internet in Iran or Korea or North Korea or whatever, what happens is that you just need one internet relay and they will give the internet to the others. So mesh networks are very interesting in this sense. Or the walkie-talkie doesn't route. So if I at walkie-talkie distance to you, I can talk to you. But then he's too far, I cannot talk to him. With mesh network, I can give my data package to you so that you can give it to him. So as long as we have somebody in the right points of the network, we can always talk. Last slide of the this is I will send you the link of my presentation about how the new things in Lightning Network connect together, and it could be interesting to see from last year in Viareggio. Now, Last slide, and then I will do a break, and then we do the last hour. The last slide is this. Layers. You have a hardware. This is a hardware, this laptop. This is a hardware. You have physical things with switches that basically they emulate a logical gate. So basically, current goes, but if current goes, the other current doesn't go. So that's it. It's a physical thing. If you create very, very complex network of these physical things, you can emulate a system which is a software. Typically, software, if you want to run Bitcoin, you will have an operative system, which is a general purpose software with many, many other functions, including commanding your hardware. And then you have the Bitcoin application, which is the Bitcoin application that will actually allow you to use Bitcoin. On here, I have Phoenix and Zeus and Arcade and Blitz and some other Bitcoin application. On here, I have Bitcoin Core, Bitcoin Notes, and a few and a CLN application. And you can run different kind of applications. So this is already layering. So you have a physical layer on top of which you have a software layer, and then on top of the software, as part of the software layer, you have the operative system, and you have the Bitcoin application. But even the Bitcoin application is divided in layers because, as we said, one layer is the time chain. So the fact that you can have this 2009 architecture invented by Satoshi, in which there is one UTXO, which is the result of of a graph of transaction, and the transactions are all included in the Merkle tree inside a chain of blocks with proof of work. So the Bitcoin layer one structure. On top of it, you have a virtualization. So you have the channels, the Lightning channels, Driapun channels, and the arcs that we just explained. The channels batch many, many transactions in time among few users. The arcs batch many, many transactions among many, many different users in a small time. So they do competing things and they can be integrated together. On top of that, you have protocols that represent other assets that are not just sets. For example, you can represent USDT, you can represent a stable coin or whatever. And that's why RGB, sometimes we were calling that a layer 3, because the idea was like, yeah, this is Bitcoin layer 1, this is Bitcoin layer 2, and this is Bitcoin layer 3. So represent is not the same kind of layerization, but is using Bitcoin transaction to represent something else, which is not Bitcoin. Now, the Lightning Network itself, usually we were to call this Lightning Network. The channels is the Lightning Network. But actually, the way that I told you before, the way that Lightning Network is now evolving, is that this is not the Lightning Network anymore. These are just channels. And the Lightning Network is like this. The Lightning Network is another layer across different channels. It's a layer that allows you to pay on-chain, on arcs, on channels, or different assets. And the different assets could be USDT, or it could be virtual Satoshis that you are just trusting somebody to give you back eventually. So credit denominated in Satoshi, or credit denominated in gold or dollars, or actual Satoshis in channels and arcs, or Satoshis on chain. And all this is the Lightning Network. And you can swap, and there is just one standard of invoicing, which, just like we said before, which is Bol 12 or other standards, just one invoicing, one routing across different assets and across different security models. Of course, I didn't put here like the state chain, because I think that from this slide here, I think that eventually here I'm listing all the different security models, just to give you an example, but not all of them will survive. Some of them I think will be completely stretched in one. So for example, full custody is kind of useless if you have Xiaomi Mints. It's just better to use Xiaomi Mints. And state chain, the ARC can do everything that a state chain can do, but a little bit more with the same cost. So I'm not sure the state chain will survive, for example. But anyway, so you have the Lightning Network. But now the problem is that the Lightning Network is tricky because we are trying to create a system of invoicing, like we said before. And a system of invoicing is basically a system of identity. If you think about the best way to pay is not even to go to SPAR and to go to a QR code and just take the QR code. If you go to Gabbani and you order lunch and you want to pay, Instead of one UX, which is pretty bad, is you go there, it shows you the QR code, you scan the QR code, you pay. It works. It works. It didn't work a couple of years ago. It didn't. Now, thanks to our clubs, it does work. But before it didn't. But now it does. But you have to go up, stay in queue, and scan it. Another option, just like Spark, could be you have your QR code on the table. At the end of the lunch, you just scan and you pay from the table because it's static. You can just use your an URL. Something even better could be that you just have on your app, like Blitz Wallet has an address book, and many other wallets are starting to come up with the idea. You just scan. There's one giant QR code, the Gabbani QR code. It's an identity. You scan it, and now you have Gabbani on your phone. Even Phoenix can do it. Actually, Phoenix can do it with Ball 12. So you scan the Ball 12 identity of Gabbani. At the end of the lunch, you receive a message through some channel, pay me, and you know the identity of the message because you scan the QR code, and you receive a pull request of money. So please pay me this, and you just press yes, and you pay. This doesn't exist now, but it will be even better. So that means creating identities. Now, the Lightning Network has many, many other problems. One of these problems, for example, is that we said that a little bit before, but if you want to do on-chain, a transaction on the time chain, you just need the private key of your UTXOs. So you just need one private key, and everything else is derived from that. It's pretty simple. You memorize one single secret, and you can use Bitcoin forever. You go naked through a border. You just remember 12 words. You get your hands on the computer. 12 words. You have your Bitcoin. With a Lightning channel, that's not the case. You need to have your pre-signed transactions, which are not on chain, they are off chain, which is good for scalability and good for privacy and good for censorship resistant, but it's bad for UX because now when you cross the border with your 12 words, you put them down, well, your channel is not there because the pre-signed transaction, they were off chain. So now you have to move a key with you. And if you destroy your computer with 12 words, you recover your Bitcoin on chain. But with 12 words, you do not recover your channel. Channel management is hard. So ARC is similar to some degree. You also have a lot of percent transaction you have to keep. Mint asset also is stuff that which is mostly off chain. So you see that you have this kind of problem. Another problem is many of these shitcoins here, many of the shitcoins of the crypto world. Here the perception is that crypto is something and Bitcoin is part of crypto. The reality I want to stress is that Bitcoin is something and crypto is just the immune reaction of the fiat world to Bitcoin. It's actually the other way around. If you think about that, the fiat world is only one guy can print money, which is the Fed, basically. The Bitcoin world is nobody can print money, and the crypto world is literally everybody and their cousin can print money. Fiat is you should trust, but only the super famous central banker. In Bitcoin is you should trust nobody, and in crypto is basically you should trust literally everybody and give them your money. So it's all the opposite of Bitcoin. Most of these crypto things, they work with basically using the blockchain for everything. For example, in Ethereum, you have something called the global rich state, which means that there is basically a computer which is not distributed, but it's replicated. So every computer of the network is running all the same programs again and again all the time. Of course, this is a nightmare of scalability. It doesn't work for real application. It does work only if it's extremely centralized, but it will not work in a decentralized version. And it's also a nightmare for privacy. But in Bitcoin, we don't have the statefulness, which is also a problem. Let's say that I want to create a Bitcoin inheritance application that after 3 years will give money to my son and daughter also, to both of them. So something has to trigger it. I can do a pre-signed transaction that will give them money. I can give it to them, and now I can imagine there will be an incentive for them to broadcast it. But if they don't receive money. Something must happen to trigger. So I can create a transaction with a bounty for a miner so that if the miner will broadcast it, they will get some money, and so they will also pay my children. But that's complicated. So my point here is that once we have the Lightning Network, I think we will see in the next few years the emergence of a way to do identity, communication, and storage and computation in a way which is supported by the Lightning Network itself. For example, in Ethereum with Swarm, every node must store our data forever. In Bitcoin, if you put the data in the op return, now there is a drama, the civil war, every node will have to store this data forever. In a smart system, you have your data, you package it in chunks, you encrypt the chunks, and then you send them around anonymous people and you pay them to retrieve them. And you say, whenever I test you, if you give me back the data, I will give you a SAT. If you don't give me back the data, I stop giving you SATs. And so you are incentivized to keep this data running. Or I need a computation. I don't have my computer. My cell phone is too small to do a computation. I could use cloud computing, but cloud computing is just another person's computer. It's not safe, it's not secure, it's not private. Instead of cloud, I use my private key, only one key, to encrypt the computation, and then I send it to you and I pay you if you do this chunk of computation. And then you give me back the result. So in theory, we could create an entire stack of something similar to cloud computing, but among a set of decentralized peers, anonymous and with strong encryption, paid with Bitcoin with Lightning Network. For example, Kit, I mentioned before the Kit application. In Kit, there is no server. Every single app is a node, and there is no central server. So I create a Kit room with you, with all of you here. We enter a Kit room. Everybody is keeping a backup of the data of everybody else. So if I destroy my phone, then I reinstall Kit, I use my key, my identity will interact with you, and you will give me back all the backup because you kept it. But of course, this is because you are my friends. But this doesn't scale very well. Let's imagine that we do a room of 2 people on Kit. If both people lose the backup, the conversation is over. So we need to scale this. One way in which the people at All Punch wants to scale it is by using a web of trust. So Matthias Boost, the CEO of All Punch, says, well, but eventually we will create a situation in which you trust some other user and it will keep some information for you. But another way is just to use payments. You pay somebody to store your data, and so on and so forth. There are some examples of that, either, for example, in Lightning Network, in order to pay over this network of nodes, you have to broadcast the messages of payment. In order to broadcast the messages, there is a communication system, which is using onion encryption and other kind of broadcast protocols. Now, can you use that to do messaging? The answer is yes. Some people came up with a communication chat application called WhatsApp, so like WhatsApp, but with sats, and it's using the Lightning Network to send encrypted messages around. It does work. Developers hate it because it's spamming the Lightning Network, because you're asking other people to relay your information for free. So eventually it doesn't scale. But we have the Lightning Network, so maybe we can do a chat in which I ask you to relay my information to the other node, but I do pay you 1 set or 1 millisecond to relay the information. So the nice thing, and then I close this lecture, is that if we pull this off, so if on top of our local computer, we can build Bitcoin, and on top of Bitcoin, we build the Lightning Network, and on top of the Lightning Network, we build identity, communication, storage, and computation, we can short circuit this, and we can basically build a decentralized computer for real this time, not like Ethereum. And on the decentralized computer, you can have a cloud, but private Bitcoin node, which is not running on your hardware, but is running on the hardware of other people that don't know each other, and you pay each single chunk of data separately. So this is just craziness, but it's just an idea to tell you which parts of the ecosystem are still missing. And the point of this final lecture is that Bitcoin is not over yet. Bitcoin is the last missing piece of the internet, but now Bitcoin needs to fix the rest of the internet, which is basically broken from the point of view of everything else. So we finished the travel, shells, virtual money, coins, even more virtual money, banknotes, even more virtual money with zero privacy, credit, back to cash on the internet, back to gold coins on the internet, but you still have a mint. You don't want a mint. You take the mint away, you have the blockchain, but doesn't scale. So you reintroduce a non-trusted third party, which is your ARC or channel coordinator. And then you can also add credit on top of that. And then you go back to identity, storage, reputation, and other things. And ideally, we can have a system as practical as the modern fiat clown world, with the same guarantees of physical shells from the point of view of privacy and security. Let's stop here for, well, just another second. Books. For the block size debate, big blocks, small blocks, you should read The Block Size War by Jonathan Beer. It's a very good book that will tell you all about the story of this kind of situation. Then Antonopoulos, again, with Lalu, the main developer of Lightning Labs, and René Picard, they created Mastering the Lightning Network. May remember Mastering Bitcoin. I'm not suggesting Mastering Bitcoin anymore because there are better alternatives, but this is still one of the very few books about Lightning. Now, read it with half of your brain, because 40% of it is already out of date, because the Lightning Network changes too fast. So this is already a pretty old book, in my opinion. There's Noble 12. There's many things that are not working this way anymore. There is an Italian translation by Riccardo Masutti, which was maybe distributed also in some event of ours. Then these three books here are the Internet of Money books by Andreas Antonopoulos. Now, many of the content of this book, many of the articles will contradict directly my thesis in this lecture. Still, I think it's important if you want to understand the crypto hype. The crypto hype, I think that Andreas is responsible of a lot of good Bitcoin education, and also is responsible of a lot of crypto hype nonsense. So I think that you should read these three books, because some of the articles will be very, very smart, and some will also show you the fallacy of the multi-coin paradigm that got many people wrecked in the last few years. Then there is another book from enemies. Well, Andreas is not an enemy, but he's not a maximalist. This is a book of an anti-Bitcoin person. I disagree with most of the conclusion, of course, because it's also seriously anti-Bitcoin. David Gerard is a Keynesian that hates gold and Austrian economics, and his point is that fiat money is fine and everything else is just bullshit. But I think it's fun to read it, because there is a lot of criticism to Bitcoin and to crypto, which I actually agree in many parts on the criticism on crypto, and the criticism on Bitcoin is important for you because they represent very well the mainstream criticism. Then if you want to go a little bit more philosophical, there is Gigi. It's an Austrian Bitcoiner, anonymous Bitcoiner, and you can read also in his website a lot of beautiful articles. Gigi is one of the best writers in Bitcoin, in my opinion, and he's also a great person. And he wrote 21 Lessons, which is a very usable book if you want to go a little bit more philosophical and philosophically advanced. If you want to read some courses in Plan B Academy, there is a Bitcoin's pioneering era, is the history of Bitcoin after Satoshi. So the Silk Road, Satoshi dies, empty Gox. So a lot of Bitcoin lore and folklore that if you like Bitcoin is probably something you want to read. Then there is an intermediate course about the Lightning Network theory. Even this one is not super new, but it's still pretty new. Then there is RGB programming. This is expert level. So expert level translate like most of our students didn't understand this course, but you can try to understand a little bit better what is RGB. Then there is how to create a Bitcoin community. And then for developers, if you are going to do the developer track, I would suggest you to read the advanced one, Bitcoin development philosophy. We don't have the same for business. We want a course, advanced course, Bitcoin business. We don't have it. So what you can do instead is you can check all our lecture of the previous business school edition if you're doing the business track. It's easier, but it's longer. So this is shorter, but harder. This is longer because you have to see a lot of lecture, but a little bit easier. And now we take 10 minutes. 10 minutes. At 6, we do the last hour.
We have a couple of questions from Discord. From Asio, actually, is there any link between Ethereum and Tether, or is it just casual name similarity?
Casual. The Tether, Ether Tether is there is no link. The guy who created Ethereum before it was acquired by Devasini is Brock Pierce. He's a notorious shitcoiner, so he was also part of the of I think EOS by Daniel Arimer, and I think he was involved in the Ethereum Foundation somehow, but no direct connection. The only thing is that after Tether realized that it's useless to pay on-chain fees on Bitcoin to transmit centralized nodes, they started to use a lot Polygon, Solana, and Ethereum included. So a lot of USDT is running on Ethereum right now.
And also another one, I think that was referred when you quoted BitChat, and they'd say, but with BitChat, for example, it can functions if we are far away from each other. So what's really the point here?
The point is that, so internet doesn't function if you are really away from any internet gateway. So if you are away forever, if you are in the desert of the Sahara and you are alone, and there's no satellite, you're out of luck. The point is that internet needs you to be connected with an internet point. A mesh network needs you to be connected to somebody who is connected to somebody who is connected to somebody who is connected to the internet. So yourself, if you have a BitChat, if you have the internet, you can still use the internet on WhatsApp or Kit. But if you don't, you can still connect with somebody, will connect with somebody, and maybe some of those also manage to have a strong VPN to the internet. And in that case, it can also bridge you to the internet. Now, BitChat doesn't do that now, but was just to explain the concept of mesh network. The mesh network is something where local networks can also rely information at large scale. There are some Bitcoin-only mesh network experiments like GoTenna, where people were trying to send a Bitcoin transaction via radio, and a lot of unexperienced experiments and stuff like that. Okay, 10 minutes. Go back. Come back at 6.65 minutes. Sorry, 6 hours and 5 minutes PM Lugano time. One, two, three. One, two, three. Pardon? Welcome back. So we start the lecture that was supposed to be 3 hours will be condensed in 50 minutes, but I already put a lot of little details that I wanted to go through this lecture in the previous one. So we are in schedule. This is a typical ecosystem depiction. This is one is from 2024, so it's already 2 years old. I put the link here so we can zoom in a little bit. And usually there are this kind of division. This one is made from river by river, and you can see wallets and exchanges. So hot wallets, it will show to you something like well, usually they're all wrong. Like they do like hot wallets. Bitkey is the one launched by Block of Jack Dorsey, which is not an hot wallet, at least not in the normal sense. There is fully noded, which is an entire node stack actually. Blockstream Green, which I will tell you a little bit more about. Mycelium is a super old wallet. So it's simple Bitcoin wallet doesn't exist anymore. There's a lot of different stuff. Lightning wallets, Albi, now the logo is different. Phoenix, Breeze, Zeus, Bitcoin Cold Wallet, Armory Foundation, Bitbox, Seed Signer, Trezor, frameworks, scaling frameworks, but I don't know even what this means. Async is just a company that does a Lightning wallet, which is Phoenix, which is this one. RGB, you see it as a company. Liquid, but Liquid is just one of the layers. Citria is like a Ethereum on Bitcoin thing. So it's all pretty messy. And then you have Dev Resources, and you find Dev Bitcoin Kit, Lightning Kit. So these are two libraries, BDK and LDK, and testnet. The testnet of Bitcoin is listed as a resource. Asset standard RGB should be here. You have BRC20, Ordinance, Rune, Taproot Asset. Taproot Asset is literally a re-implementation of RGB. The original name of Taproot Asset was CYNK, which is the other color scheme from RGB. Basically, the history of Taproot Asset is we tried to convince Lightning Labs to implement RGB. Lalo didn't like our documentation and code because back then it was pretty ugly. So he re-implemented everything from scratch, and that's Taproot Asset, which is the same as RGB. Utilities, mining, you can see mining pool together with production of ASICs is pretty messy. eCash, Fedimint, and Cashew. Social, here are mostly Noster clients, and now miscellaneous, which whatever, like Jam is a coin join application. Jam is a wallet, just like Wasabi, but Wasabi is up here and Jam is here. Now, this is pretty, now you have funding. Human Rights Foundation gives money to people. Blockstream, this gives some money research. OpenSats, Spiral, Brink to core developers mostly. So I gave you this example because this is one of the least bad and is still pretty bad. So I will try it. So if you find other of these, some of these may be updated to 2026, but they will be even worse in terms of logical ordering of the things. And because usually they have done, up to 2 years ago, this was typically a job of an intern. They were just grabbing random logos. And now is even worse because they will just use large language models to do it instead. So the result will be even more messy. So let's try to organize everything from in a more logical, from a more logical point of view. Before, I want to show you another messy slide, but this one will be honestly messy in the sense that I don't pretend there is any order. It's just a bunch of logos put together in a random order. Just to give you a few examples of the companies we are often working with, because Plan B is sponsored by Tether and Fulgur. And Tether, both Tether and Fulgur, they are not just companies, but they are families of companies with different kind of investment, joint venture, partnership, and co-owned companies. So this is a random slide of random things that you may hear about. Tether, I already told you the history of Tether. So it was just that stuff doing eCash basically, but on Bitcoin, and later eCash on shitcoins, and that became very, very big. One of the reasons I didn't explain before, one of the reasons Tether is very, very big is because initially the dollars were sent to a bank of the company Tether, and then Tether issued the digital note around. But then a lot, just like in banks at the beginning of the history of money, more people were sending money in than taking money out. So a lot of collateral started not to circulate outside but to remain in. Instead of doing fractional reserve, Tether started to basically, when the collateral started to be 4 million, 40 millions, 400 millions, 4 billions, they call the banks and they say, what are you doing with our 4 billion dollars? And the bank said, the only thing I can do, I buy treasury bills from the United States because they are the only things that are liquid enough that I can sell them as cash and redeem immediately. So Tether just said, why should I pay you as a bank to use my money to buy T-bills and keep them there? I would just buy T-bills. So Tether took the phone with the treasury of the United States and they started to buy T-bills. By that time, the interest rates on T-bills, because of the choice in monetary policy, skyrocketed, historically speaking. And so Tether made a lot of money, becoming the highest revenue per employee company in the history of mankind. That's Tether. Fulgur Venture, instead, is a VC fund which is funneling money into Bitcoin thing, and mostly Lightning thing. Fulgur in Latin is the lightning, so it's clearly lightning oriented. These are a bunch of companies that are in the family. So you can see, for example, BitDeer, they are doing ASICs and they are invested by Tether. Ocean, it's a mining pool and it's invested by Tether. Bitfinex is basically co-owned into some degree, and it's the exchange that for which Tether was initially acquired. Hole Punch, I told you before, there is a company doing pairs.com and Kit. Synonym is doing the world BitKit and also the standard pub key. Rumble is an alternative to YouTube. Tether just acquired it, and now you can do like on YouTube, but you can also send USDT and Sats via the WDK wallet. Naka, they did the original payment system here in Lugano. Hedron, they are issuing things. Gentry, they're consulting nation states to do Bitcoin adoption. Hodl is a non-KYC exchange, which is centralized, but also allows peer-to-peer exchange with no KYC. Debify is a Bitcoin over collateralization loan. Rely was just an exchange. It was low KYC before, now it's KYC again, sadly, and it's a very strong in Switzerland. Breeze, well, now let's move to something which is either Fulgur participated or both. Blockstream is a company that was created to basically was funded many years ago to create the first Bitcoin sidechain. The idea of a sidechain is a second layer where you can just do something different from Bitcoin in terms of scalability, programmability, but the assets is not a shitcoin, it's just Bitcoin that can go in and back. The elements chain that I show you here, the second step in this ladder is the equivalent of Liquid, which is the main product historically of Blockstream. Now Blockstream evolved to become actually also a treasury company and like an investment company. It's a brand that is covering many different things, and hopefully we will have again the assignment by Blockstream also for this year, hopefully. And Breeze is a company started with a Lightning wallet, and then it basically pivoted to an infrastructure company, which is creating libraries and toolkits for other people to integrate Lightning wallets. So instead of Breeze is still producing consumer grade wallets, so you can download Breeze and other wallets made by them. Roy is very usually a teacher in our initiative and is also part of usually our summer schools, and he will be here for sure this summer school as well. Galoy, I already mentioned, they are very big in El Salvador. They moved to El Salvador and they do a lot of banking infrastructure, and they did the Stable Sets initiative and they co-produced the Bitcoin Beach wallet. Albi is a great, it started as a Chrome extension to do, well, if you come from the shitcoin world, it's like a MetaMask for Lightning. But now is actually creating an entire stack of very interesting thing. Art Clubs, recently invested by Fulgur and then also by Tether, is creating one of the two main ARC implementation, which is Arcade, and you will have its CEO as a teacher. Fold is one of the companies of the Fulgo portfolio that actually went public, so it's pretty big. So yeah, Bitrefill, ZBD, DIBA, LM Markets. I'm not sure. I'm probably forgetting something. Well, Umbrel is also a company invested by Fulgur, and I think Casa Hodl as well. So for sure I'm leaving something out. But this is basically to tell you that the ecosystem is very, very big. Now, well, I forgot one. 21, which is the new treasury company by Jack Mallers with Tether inside. Now, let's go through the evolution of the business landscape, which I divided basically in 5 different stages. The first stage is what I stealing from SBAM, the name of Paleo node. So basically, you have to know that when Satoshi created the software, he didn't have the idea of creating separate software for different separate uses. The idea of Satoshi is just create one program that will do literally everything that has to do with Bitcoin. So it was a Bitcoin node to receive and validate transaction. It was a Bitcoin wallet to generate keys, store keys, and sign transactions with keys. It was a peer-to-peer connection program to connect with other nodes and try to exchange information. It was also a payment protocol to call other nodes IPs and negotiate a public key. It was everything together. Not only that, it was a miner, of course. That when you were mining in 2009, you were just using Bitcoin QT, the software created by Satoshi, with your CPU to mine. No other software was necessary. Every computer with a CPU was mining with the Bitcoin software. Not only there was a system that was never really refined, that was a trader to do merchant. Um, Actually, this is wrong. I wanted to say, sorry, just a small correction. Or gaming could also be it. So there was a system inside the node to do a decentralized market. So the early code by Satoshi was preparing a marketplace in which each Bitcoin node will signal to the others that they have a product or a service to sell, and they will accept Bitcoin in exchange with a price. So something like a decentralized Silk Road was already included in the early Bitcoin code. Now, was it working? No. Is it trivial to make it work? No, because the fact that if we still don't have something like decentralized Silk Road in 2026 should tell you that it's pretty hard. And the reason is basically this: you have to have a place where to put the. So, for example, you want eBay, decentralized eBay, or decentralized Vinted. Where do you put the image of the product? On the blockchain, but then it cannot scale like you will do in Ethereum. So you need a storage system. It's pretty complex. So Satoshi never resolved it. You need reputation. How do you rank the merchant? You need a reputation system, identity. Payment is just one of the several things you need. There was one company created to do this called OB1, Open Bazaar One, OB1. They failed. Now there is BISQ, which is mostly a decentralized market of fiat, but it's kind of working. But it was still very, very early on. And so Satoshi tried, but then he gave up. Then, with the M, gambler. Well, anyway, we correct. Then Satoshi said, okay, I cannot do a decentralized markets. It's too hard. So there is still some code in the early release, but it's all commented out. But I still want people to do something with Bitcoin. So he tried to implement inside the node, inside the same software, a poker tournament game. Because he said, okay, what people can do with money? Well, gambling or gaming. So let's ship Bitcoin with a poker game inside. And he tried. It was pretty complex to do a poker game. So after a while, he said, let's just focus on Bitcoin. So the idea was that you can be a miner. You can be the first roles in the Paleo node is either you mine Bitcoin, so you give your energy to issue proof of work to yourself, or you are a merchant, so you sell something on the market that Satoshi created, which didn't work, or you are a marketplace provider, so maybe you just match demand and offer of some services, or you are a gambler with an M, so you're basically just, or a gamer, and you're just playing poker. Poker is not really gambling, it depends, but that's just to give you an idea. Then things start to specialize a little bit, and let's try to depict it this way. You have the Paleo node that does everything, Now the market dies, the centralized market dies, the poker tournament dies, and you just remain with the rest. Now you have the splitting of mining tools, and then I will argue that you have the splitting of the wallet tools, and then you will have other splitting in the future. So from the original node, different functions are branching off. For example, in around with the first mining pool created by Slash in Prague, you started to have a specialization of mining. For example, instead of everybody mining at the same level, people realize that mining has a very high variance. So basically, let's say with my hash rate, I will get a block, but I will get a block every year. Now, that's not bad because the amount of money in a block can compensate for my cost for a year, but I have to wait 1 year. And maybe if I'm unlucky, 2 years, maybe 3 years. So I can easily go bankrupt before I can find my block. So the idea is if if I just mine together with other 364 people as big as me, so now we will find a block a day because now we are 365 times bigger. So we will find a block a day instead of a block a year. Now with a block a day, we can survive. So we join together 365 people, and each time one of us find a block, they will divide the block reward with all the others. This can be This is very hard to do trustless. So usually that's trusted. Somebody will say, I'm the pool. Please, I give you the blocks, you will work on it, but the Coinbase, so the address, is not going to you, it's going to me. When I get the Coinbase, I will split the Coinbase to everybody else fairly. Just trust me, bro. And that's kind of works, even because if I scam you once, the next block, you are not giving your word to me, and you just go to a competing pool. Luke Dashir created a second big mining pool, Eligius, which now was recreated as Ocean, and there's a lot of interesting stuff to be said about mining pool. So pool provider, that's a job. Pool provider means somebody that will basically become a trusted temporary aggregator for many people trying to mine together to lower their variance. Then there is the usher. The usher is not a miner anymore. The usher is somebody that will just trust the pool provider to do hashing without even knowing what is inside. So the original miner in 2009 was getting the transaction from the mempool, aggregating them in a block, selecting them, like this pays more, this pays less, and creating the block candidate, and then hashing on the block candidate and finding the block and keeping the reward. With the mining pools, the hasher doesn't even know the block exists. The mining pool will collect the transaction. They will sort the transaction. They will send the hash to the hasher, and the hasher will just try to solve the proof of work. They are basically just renting their power. Ocean, for example, is an interesting company because it's trying to make the hasher a miner again. So it's trying to be a pool where the single miners can actually create their block on their own independently, which is good for decentralization. Then there is ASIC producers. So as we said, you have at the very beginning, 2009, you mined with your CPU on your laptop. Then you needed a computer with a gaming computer with a GPU, just like with artificial intelligence right now. Then you started to have programmable chips like FPGAs, and then chips that are just created for these, like which are called ASICs. Now, being an ASIC producer is a job, or well, it's an enterprise, and you can work for a company that are producing ASICs. Just like in this slide, an example of marketplace is Bitfinex, an example of mining pool is Ocean, an example of ASIC producer is Bitdeer, for example. And then you can do information broker content creator. You can do people around 2011, 2012 started to create content on Bitcoin, a podcast, and you just look at the podcast. I get paid from the sponsor, or I create a conference. In 2011, there was the first conference in Santa Fe, and then my first conference was in 2014 in Amsterdam. Was a very nice conference, and I paid my ticket. So that was a business model actually to give me information, let me speak with the developers and entrepreneurs, Roger Ver and Gavin Andresen, and I paid for that. So then we had another branching. People started in 2009 using Bitcoin Core, the program, which was not called Bitcoin Core back then. It was just called Bitcoin Qt, and they used the program by Satoshi to generate private keys, derive other keys, derive public keys, and sign the transactions. Then people started to think about multi-sig, complex smart contracts, but the Bitcoin program, so Bitcoin uses script, which is a language to do smart contract, but the Bitcoin program itself didn't allow you to build a smart contract. So you open Bitcoin in 2009, there is no function to create a transaction with two signature, 2 out of 3, a lightning channel, an arc, a time lock for your future, an inheritance. You cannot do it. You can, but you have basically to write the transaction by hand in command line, which is very, very risky, and people should not do that. So people started to create different tools outside of Bitcoin Core to manage complex transaction. One example is Electrum. Electrum is a very old, still maintained and still pretty common Python wallet, which allows you to do multi-sig, Lightning channels. That's it, but it's already a lot of stuff. And then now there is Sparrow, which is also very good on multi-sig and CoinJoin and PayJoin. And there is Spectre. There are other kind of wallets. Of course, there are all the Lightning wallets, which are Lightning is not supported in Bitcoin Core right now. So if you want to use all Bitcoin, including the second layers, you have to use specialized software and not Bitcoin Core. Another example of branching is this, hardware wallets. So right now, the wallet is a particularly confusing word in Bitcoin because people, like, you remember when I said that coin has many meanings, because Satoshi was using it to indicate what we call UTXO, what we call Satoshi, and what we call Bitcoin. Well, wallet was used by people to indicate either the single UTXO. So, for example, in many cases, you will look at the newspaper article, and they will say there was a hack. The hacker has been paid in Bitcoin, and the FBI is tracking the wallet on the chain. But you cannot see wallets on the chain. You just see UTXOs, coins on the chain with addresses. But sometimes they call it wallet. And then if you download a software that will allow you to generate key and store key, that will be like Sparrow, Electrum. That's called a wallet. But then when you open Sparrow on Electrum, they will ask you maybe to connect your cold card or your portal or your Trezor, and that's called an hardware wallet. Also, inside Sparrow and Electrum, every time you open a new identity, so you create a new key, it says file new wallet. So basically, what you do is you open a wallet, Electrum, to create a new wallet, your wallet, to connect to a wallet, the cold card, and then you generate UTXOs that journalists will call wallets. So it's pretty messy. But just to tell you that right now, very few people use Bitcoin Core as a wallet. Nobody uses them as a mining tool anymore. So there was all this division of competencies. In the early ecosystem, a few years ago, the main roles for business structure was, so basically, what can you be paid to do? Either you are a custodian, I give you my coin, I pay you for that. Somebody could think that's stupid, but actually there is a market reason for that. Many exchanges are also custodian. For example, I want to sell Bitcoin for euro. I need to send you the Bitcoin, you keep it. The buyer will send you the euro, you will keep it. Now we exchange, now I withdraw, now they withdraw. This is a custodian function, which is needed, because if I directly send my Bitcoin to random people I don't know, they will just run away with the Bitcoin. Then there is the role of trader. For example, many companies are doing trading, many individuals are doing trading. ATM producers, like one of the richest company in Bitcoin, which now you don't see much about anymore, is called Lamassu, like the goddess. And Lamassu were a company doing Bitcoin ATMs. So boxes where you put cash and you get Bitcoin. They were big in Portugal, and they started to expand. They made a lot of money early on. They kept the money in Bitcoin, so that was a good choice. And now they have a lot of money, but it's not a very important business anymore. You don't find a lot of Bitcoin ATMs, mostly for regulatory reasons. Um, Synthetic assets provider, something like Tether, event organizer, one of the big companies in the place, BTC org, they organize the Bitcoin company, and you're like Plan B organizes the conference. Event organizers is a job in Bitcoin, is one of the main revenue stream actually. Today there are many other things that I will not enter too much into details, but let me move to this. Well, let me first give you a personal story and then move to attempt to a little bit of schematization. So personal story. In 2013, I quit my job in Accenture to do Bitcoin things. Most of the things were shitcoin startups that failed right away in 2014. But the first Bitcoin thing was becoming the biz dev of Green Address. Green Address was a wallet, a Bitcoin software wallet. It was the first one to use multisig with P2SH, the new format of addresses. The first one to do the hierarchical deterministic generation. So the first one in which you just have one key and you derive everything else. And there were a lot of very, very cool features. My job was to provide capital to the company. So I was meeting with investors, and my boss, Lawrence Naum, was just doing the code together with the developer, the Polish developer, Jerzy Kosera. So they were coding, I was doing biz dev. So Lawrence was the CEO. So usually I got the business partner, the investor, and the conversation was almost always the same. 2014, do you have patents? No, you see, man, it's all open source. Okay, but maybe this, and then Lawrence was saying, okay, it's open source. Actually, the server is closed source, but I'm going to release it next year. So you see the attention of the investor start to fade down a little bit. Okay, it's open source. Everybody can copy you, but at least maybe you can get data of the user, so you can sell advertising, targeted advertising. And then we are saying, oh, sorry, we have no data about the users. We don't want any data. Everything is anonymous. We have no targeting information about the users. And Lauren was saying, actually, probably we can target the users because by the fees that they pay to Green Address service, we can identify them on chain, which is something I'm going to fix next week. No problem. So everything was basically going away. So maybe every kind of business model we were finding was easily destroyed because Bitcoin is a weird business beast. Bitcoin is about disintermediation. It means that it will try not to let you intermediate it. If you intermediate it, you create a single point of failure. Bitcoin doesn't like that, and it will try to route around you. So either you deviate a lot from Bitcoin, but if you deviate too much, Bitcoiners will not like you and will not buy your product, or you stay very close to the ethos and then you make zero money. Now, I don't want to depress you. There'll still be some kind of sweet spot, but it's very hard to find and usually comes down with very few things. So what we did to survive, one was a partnership with an exchange. Their trading was an old exchange between fiat and Bitcoin in Italy, and they wanted they had the people that were trying to withdraw Bitcoin. So the idea was, with Readdress, we provide infrastructure where all the accounts are 2 of 2. So the first signature is the one of the user. The other is from our server. Our server will make sure that there is no double spending, like a mint, basically. So we are playing the role of a mint, so the people can do instant deposit and instant withdrawal. That's good for trader because you want to keep Bitcoin in cold storage or in storage. Then you see you want to sell. You want to sell, but you don't want to wait for one confirmation to want to sell immediately, and you want to withdraw immediately. That was a nice idea. They implemented it, but then a few years later, some money disappeared, and now the two guys are friends. They are in jail, and the exchange is completely bankrupt, and all the customers lost all the money. So that was not easy to do, basically. Second attempt. Okay, we cannot target our customers. We don't know who they are. We don't know gender, age, location by design. We know they have Bitcoin, and we know they use Bitcoin. That information, we have it. So let's partner to Bitcoin hardware products. So we partner with Ledger, and we said, guys, we will put a link, buy Ledger in the wallet. They buy referral to us. And we did this kind of Ledger. This was the very first ledger hardware wallet, the HW1. It was basically a chip that you click and it becomes a USB key and you put it in the computer. It was a scam though, because there is no screen. So the computer can just have it signing whatever they want. So there's, well, not a scam, but very, very low security, just like BitKey right now. And so not a great idea. The idea was actually to provide security by the second signature. So actually the wallet itself was a little bit of a scam, but our version was not, because the thesis here was you don't have a screen, but if you use green address, before you can send a transaction, we will send you the two-factor authentication with all the information on your cell phone. So now you have the screen, which is the cell phone. So it was a nice idea. This one was Bitboat, created by your friend Thomas Bertani in Italy. Bitboat was one of the very first cash to Bitcoin services. It was using a prepaid card by Italian Post Company. Italian Post Company had no idea about that, of course. It was possible to go to a place and say, I want to refill this card. And you gave the tobacco guy, the shop guy, the number of the card, you give them cash and they charge it. So Bitbot was an escrow that allowed people to charge everybody else's card in exchange for escrowed Bitcoin. And it was going very well. They were making a lot of money in fees. And we just said referral. So yeah, there was a button in green, buy Bitcoin. Buy Bitcoin was showing you the place to go next to you to do cash, and then you get Bitcoin. It was cool. But like this was shut down. These are in jails, and this became a shitcoin company. So I don't know. It's hard. It's very hard. So I want to give you a general view of Bitcoin business models. And before we close this down, it's a little bit faster than expected, but it's fine. There are two main categories of business models on Bitcoin. Easy business models. First, you harvest and sell user data. Very easy. It's against the Bitcoin ethos. The main point is private cash that cannot be tracked and censored, basically the full idea of Bitcoin starts with privacy. Then you can print or shield scam tokens. So you print money out of thin air. That also against the very concept of Bitcoin, which is digital scarcity. The point of Bitcoin is that you cannot print it easily. So a business model you can do is just you print something and you call it something like Bitcoin, but better. Or you shield it in the sense that you don't print it, but you resell it to retail investors. Then you can infect companies with ransomware. That's very practical. One of the problems of ransomware always existed, is a software that will infect your computer and threaten you to delete your data or something like that if you don't pay. Ransomware was very hard to monetize because the payment information in fiat was usually traceable. But with Bitcoin, ransomware worked great. So that's also a business model. Or you can do patent trolling, and you can try to create patents on Bitcoin and to threaten of jail other people.
That is also the best business model, which is kidnapping Bitcoin.
Okay, kidnappings. That's especially a French business model, which is very recent, but it works. It works pretty well as well. It's a business model. Now, these are easy. Let's move to hard business models that are the ones that don't involve hurting people or stealing their stuff or defrauding people. So easy business model, they are zero or negative sum games. They basically imply kidnapping, extorting, blackmailing, defrauding, and scamming. What about the hard business models? What I identified basically is these six patterns that keep repeating and repeating in almost all the business that I've built or analyzed. The first one, which is very, very profitable, is the role of financial services. Wealth is coming to Bitcoin. Slowly, inconsistently, with volatility, with 4-year cycles, but wealth is coming to Bitcoin. Wealth is in fiat. So if wealth moves from fiat to Bitcoin, if you put yourself there as a bridge and you charge a fee to cross the bridge, you make money. As simple as that. Somebody wants to buy, somebody wants to sell. One hand of the trade is fiat, the other is Bitcoin. Is this profitable? Yes. Is this something I would like to do? No. That's a very, very fiat company because the Bitcoin leg of the trade is Bitcoin. You can also have fun building security and stuff like that. But the fiat hand of the trade, you have to do wire transfers, KYC, AML, freezing accounts. You have to maintain banking relationship. Is very, very boring. Very profitable, but very boring. Uh, of our companies that I listed before, Bitfinex was a very, very big exchange, also very innovative. Also a lot of security risk. You become a honeypot. You become a place where so hackers can attack each of us, but for small amounts, and maybe the risk is not worth it. If they attack a big exchange, they can have a large amount. So when you operate an exchange, they will just attack you. Then software services. Basically, you build software and you try to charge it somehow. The somehow is the problem. You cannot do software as a service easily. If it's a Bitcoin software which is connected to security or privacy, it should be open source. If it's not open source, I can just put there a backdoor to steal your coins or to track you down and anonymize you. So it should always be open source. Maybe the back end can be closed source, like in industrial secret. That's possible, and sometimes that happens, but it's very hard. Usually, software works in the sense of consultancy/integration. So you get paid by somebody to develop a software that was not there, and they need it. But once the software is developed, to monetize on it, especially with license models, it conflicts a lot with the open source nature. Of course, you can still do open source, so reviewable code, but not enforceable. But not copyable. So I tell you, this is the code. You can check it so you know there are no backdoors. But if you try to copy it, I sue you. Some Bitcoin companies are trying this way, but still Bitcoiners are not super happy because open source is not just part of the security model of the app. It's also an ideological aspect of some of the grassroots ideological foundations of Bitcoin. So we don't like it very much when people try to enforce patents. Then there are functionary roles. One example is mining pools or oracles that get paid, or LSPs or ARCs, ASPs, ARC service providers. So you run a software, you don't keep other people's money, you don't develop software for somebody else. Your software will allow you to interact with users, and the user will just leave you a fee because you provide a service. A mining pool lowers variances. A coin join coordinator help to coordinate privacy. A LSP connects liquidity. A swap coordinator like Bolts will help you to coordinate an atomic swap across different layers. Then there are hardware products. You sell a hardware wallet, or you sell an ASIC to a miner. That's building hardware, basically. That's pretty. One advantage of hardware is that hardware, even if it's open source in the sense that you can easily review it, cannot be copied trivially. If I give you a Trezor, you don't have a magic replicator to create another Trezor. So that's good. You can just create another thing which is identical and sell it like something else, like they did. But at least you don't. The hardware also, you can you can try to charge very, very high margin, because people tend to always give psychologically, people tend to give a lot of premium to physical objects over, for example, the use of a software. Then there is something which I think is very interesting and often overlooked, which is monetary use. So you do something else and just use Bitcoin as money. For example, medium of exchange. Our very good friend started one of the very first e-commerce for hardware in 2013. And a lot of people wanted to buy hardware in India, and payment in fiat was very, very hard from India to Europe. So they used Bitcoin. They served the market that without Bitcoin was not impossible. The business was not on Bitcoin. They were just using Bitcoin to enable something that was not possible before. Another good example is the proliferation of VPNs and anonymous eSIMs. You could always have a VPN, anonymous eSIM. The problem is that if you have to pay with a credit card, that's pretty pointless or even dangerous, because it becomes a honeypot. Now you can with Bitcoin, and most of them accept Bitcoin. Monetary use doesn't just mean medium of exchange. It can also mean store of value. So I'm a company with a lot of treasury. I put my treasury in Bitcoin. If I have more than 4 years of buffer, I will make a lot of money. I would have made a lot of money in the last 20 years, 15, 16 years. Of course, if I am a company that cannot allow for a 4 years buffer, then I can receive all the money when Bitcoin is 120K and spend it when Bitcoin is 90K, which is bad. So treasury company is a thing. Now, recently, the treasury company became a trend, not really of companies that are just keeping Bitcoin for their treasury, but they're actually selling this service to the investors. How does it work? Why is that? At the beginning, because there was no ETF, there was no synthetic Bitcoin. So if you were an institutional investor and you wanted Bitcoin, you could not buy Bitcoin. So what you did was to buy a public company buying Bitcoin. But now you have the ETF. But then there's still something interesting, because they realize that the public companies, they have usually very good access to credit. So they can borrow money with very low interest rates. So if you let's say that you are very bullish on Bitcoin, you want to buy Bitcoin, so you want to go to the bank and get a loan to buy Bitcoin. Your price for the loan will be bad. Your interest rate will be pretty high. So you can do it, but it's not great. A public company does the same. Their access to credit will be very, very, very good. So what they do is, if you buy their share instead of buying Bitcoin directly, you get some kind of arbitrage in the interest rate. That's just it. Like all these treasury companies are just doing this arbitrage. Then there is the last one, is knowledge brokerage. Bitcoin is something new, something different, something complex, something multidisciplinary, something weird, something disruptive. So people want to know about that. Uh, this is like the first company that I tried to build that didn't fail was just knowledge brokerage. So we realized. So it was funny, because I was working for Green Address and other like 5 shitcoin companies, and nothing had a reliable business model. So we were just losing money, and I was using my personal money to keep the companies alive, and that was not great. And then we needed to eat, and so I started to teach Bitcoin to Italian banks and the national post office and the national train industry, and I started to basically do consulting and teaching. And then I noticed that the pattern was, well, I teach Bitcoin to get money and I spend Bitcoin on startup that fail. So maybe we can industrialize this. So we created a research center where these companies could pay directly in order for me to us to invite all these experts in Milan to work on Bitcoin. What is the trade? The trade is, you bank get exposure from the best Bitcoin minds, and you can get reports and intelligence services on what's happening in Bitcoin. The startuppers are happy because they want to tell what they're doing. It's not a secret. It's not really, it's all open. It's nothing done in secret. And in exchange, we get the money and we can maintain them. So it was a good deal. Almost, my thesis is that almost all these things, kind of fall. I can make you a few examples, but basically they fall somewhere here. I didn't find a sustainable model where you can either you are trading fiat with Bitcoin, or you are selling information on Bitcoin, or you're using Bitcoin as money, or you're selling hardware, or you are getting paid in sats for services you do to Bitcoiner, which is still monetary use, but the only difference that now is monetary use for a service which is Bitcoin specific, or you're just doing software services. Didn't find any counterexample significant, at least. Sometimes I think I want to rearrange this polygon in different ways, but I will see next year. So, pain point. This is Hide the Pain Herald. This Bitcoin is this is very similar to the Internet revolution, actually. During the Internet revolution, people could make a lot of money with the dot-com bubble and with digitalization, but there was also always a conundrum. The conundrum is that you have low capital barriers to entry, and so everybody can do a website. So you need to find a way to monetize. You cannot gatekeep anymore in the physical sense. So Internet revolution was basically lowering the cost to access to information. So how did the people made money on the internet? Well, in different way. One, centralization. You can have 100 different eBays, but then you don't have good price discovery. It's better to just have one, convergence. So eBay becomes very big, centralized. You can have many research engines, but then the most efficient is that everybody's going to one. Social network, even more. If everybody goes to one social network, you have more value for the social network. Surveillance. which is basically the idea that you spy on the customers so you can sell the data to advertisers or to the government if the government wants to force you. Hype. So the internet was created in a the internet economy was always based on super shiny and noisy announcements of new things, novelty effects. Everything must be new, everything must be advanced, everything must be a new revolution, everything must be disruptive, move fast and break things. And then, of course, printing money, Cantillon effect. The idea that the internet revolution allowed basically in its last phase, which I think is crypto, which is the last stage of the fiat internet revolution. Is the main business model is to print tokens and to print money for everybody. Bitcoin revolution is basically, my thesis would be that the Bitcoin revolution is the other way around. So instead of centralization, big websites that accentrate all the power and concentrate all the power, you have decentralization. Of course, decentralization is hard to monetize because you are disintermediating. You are basically removing yourself from the equation to let the user interact with the other users directly. The more Bitcoin-ish you are, the less you are intermediating. Privacy, uh, of course, surveillance was the business model of the internet until now, and Bitcoin is based on privacy and is focused on privacy and is useful for privacy. So just like the same problem I had with investors in green address. One thing is that you want to be blind, so you cannot spy on your customers. But then the regulation will sometimes the regulation will force you to privacy, like GDPR. Sometimes the regulation will try to force you not to leave privacy, like KYC, AML. Then stability, just like internet companies, crypto companies, fiat companies, DeFi companies, Web3 company, they are based on continuous hype cycles. Bitcoin tends to be Bitcoin tends to be intrinsically boring by vocation. We try to make stuff stable. We try to make stuff that will not change every year. The rules of the Bitcoin protocol should not change every year with a big announcement. The monetary policy should not change every year. The proof of work should not change every year. The layer one rules of the script should not change every year. Even Lightning, which is new and changes a lot, is reaching some levels of stability. And then, of course, the concept of scarcity, which is a concept of restraint from the temptation of printing money and competing with the money printer and instead using the same monetary open standard. So, okay, this is also over. I managed to stay in the time, and we also have 4 minutes for questions if we have some. No question local.
Just one from Discord. Why can't we use Kit for communication inside Plan B?
We can't, and we did try the very first year. So the first Plan B school that we ran, we used Kit. One problem of Kit was back then was mostly that updates were too frequent, and so every time we were starting, well, not every time, many times we were starting a call for the lecture, and then we started to have problems by people stop. I have to update. I have to update. A lot of breaking upgrades. The second problem is that UX is getting better now, but back then, like even just 1 year and a half ago, when we started, 2 years ago, 1 year and a half, it was not as good as now. For example, in the Telegram group that was censored by Telegram, and in Discord, I assume there are topics. In Kit, you cannot yet have one chat with topics. We will have to create different rooms, and in each room, we will have to recreate the entire population of the classroom. So that's doable, but very, very, I think it would be a little bit annoying from the UX point of view. As soon as Kit has topics like Discord or like Telegram, we can probably use that. The third reason is that there have been a lot of effort going on to integrate All Punch technology directly in the PlanB.Academy platform. So the idea was using Kit is redundant because in theory, Kit is based on these primitives that are Kit is closed source, which I don't like very much. The primitives used to build Kit are open source. And the idea is that you can recreate a Kit on your own based on the primitive. So we say, let's do that instead of using Kit. Let's use the Plan B Academy app built on top of the same technology, which is something that the devs are doing and eventually will happen, but right now is not has not happened yet. So right now, even there is some level of integration, but not such that you can use it yet to communicate like Discord. So let's go with Discord for now. Yes.
Yes, I have a question. Yeah, during the lecture, you mentioned about the 12 words to recall your private key. Why is 12 words and not 18 or 24? And
Yes.
the other question is, you mentioned also about Nano S from Ledger. Is it safe enough from your point of view?
So first, 12 words. The first, so the one of the very first, the first hardware wallet in the market, or signer, or Bitcoin signer in the market, was Trezor in Prague from Satoshi Labs, and it was a great deal. Ledger arrived a little bit later, and it was the first functional signer to do Bitcoin stuff. The Satoshi Labs people became very important, very famous, and they also did, they created a few BIP, Bitcoin Improvement Proposals, that people that will do the technical track, you will see what Bitcoin Improvement Proposals are, and you will go through Bitcoin Improvement Proposals. If you are still curious and you're not in the technical track, you can go back to my material in the past tech school, and I did all the lecture about all the BIP, listing all the BIP. And there is a BIP 39 is one standard that Satoshi Labs and Trezor came up with in order to basically memorize or write down easily your private key. So remember that in Bitcoin, after BIP 32, before this, every Bitcoin wallet generated one private key for each new coin, which was very uncomfortable for backups, keeping everything in sync. With BIP 32, there was a smart idea: just generate one private key. From this private key, you just add a little bit of modification, which is private, nobody can see it, and you create the private key number 2, and then the number 3, and then number 4, then number 5, and so on. And you can create thousands, one private key for every wallet, for every coin, for every address where you want to receive is different. But when you have a new phone or a new computer, you just put the original private key, and then your computer will easily regenerate all the others. From every private key, there could be a correspondent public key, which is basically the address of the wallet or something like that. Now, this BIP 32 was very, very good. And then the idea was how to record the main public key, the main private key, because here you don't record it. If you don't have BIP 32, your computer will have to just have a backup, which is a file, and you will have to keep the file. So there is no way you can remember all the infinite private keys you're going to use. But now you have one private key. So maybe there is a way for you, instead of just copying a file, you can maybe writing down on paper or on metal or whatever. So Satoshi Labs came up with the BIP 39, which is the way to encode this private key, which is easy. Actually, it's not really the private key, is derived by the seed of the private key is derived by the seed phrase. And the idea was to create a dictionary of several words of different languages. And from this dictionary, to select 24 words in order to create the good entropy. Or you can also do 16, or you can also do 12. After a while, people did a little bit of cryptographic calculations, and they basically they understood that collision-wise, 24 words don't provide a significant advantage in collision resistance compared to 12 words. So 12 words are easier to store, transmit, hide, move, copy, but they don't significantly have less resistance to collision. So it's a standard right now to use 12 instead of 24. If there was some advancement on cryptography that weakened a little bit SECP curve or elliptic curve cryptography, maybe we will have to review that. But right now, 12 words are okay. Where 12 words are not okay is usually where you want to do key splitting. So sometimes you don't want to have a multi-sig, like my signature, your signature. I just want to have my key split in several parts. That's not always advisable for several reasons, but sometimes you want to do it. If you have 24 words, it's easy to do 16, 16, 16. So you create a 2 of 3 basically, which is local. If you have 12 words, if you split it in 2, it's not safe. Or you split it in 3, is not safe, because 1/3 is lower entropy enough that an attacker can easily guess the others with the computer. So long story short, 12 is okay. Less than 12, no. Up to 24, only if you have something complex going on and you have a reason to do that. Otherwise, you can just stay with 12. Now, is it a good standard? I don't think so. I think it's very ugly. It's so, for example, it has a checksum. So, for example, you cannot generate these 12 words with dices easily, because you throw your dice to select the words, and then the last word is a checksum on the other. So you have to calculate it with some kind of hardware. And then again, there is no versioning in. So if there is no birthday, you don't write. There is no standard to write down which wallet you used and which date you create the wallet, which is very important for the derivation step, the birthday problem when you recover a wallet. So I think it's a bad standard. But the problem with standards is that when a bad standard becomes a standard, it's a standard. So now to change the way 12 words work, it's hard. Many people tried. Social recovery, Shamir shared secrets. But now Jack Dorsey is fighting against it. He did also a lot of advertising. Lose your seed. Seed words are bad. Just use BitKey hardware. Risky, but it's not a very good standard. Now, Ledger, is it safe? Depends. I think that even here you can do a spectrum. So on one side, imagine that you have an old laptop that you bought on with cash in Chinatown with a mask on because of COVID. So you bought it in cash, and you put Tails on that. Tails is a privacy-oriented operative system which comes with Electrum integrated. So that's pretty good. Laptop with Tails. It's safe enough, it's good, and you put your private keys there. Of course, it's Tails, so remember to activate memory, otherwise you lose all the keys. So now, on the other side of the spectrum, you have a Ledger Nano S. Is this safe? Well, inside of it, there is a secure element, which means a chip that if you try to open it to read the private key, it will be destroyed. Not even with a multi-million equipment with electronic microscope, you can actually open that. It's very, very safe. So which is safer? Well, depends. This one, your maid, your cleaning lady is a hacker, is gone. There are many, many ways to, if somebody is expert, there are many, many ways to read the memory from a normal commodity laptop. Even if the disk is encrypted, if you load the keys in memory when you sign, maybe you leave something there. So if there is any incentive, so if you have real money, let's say 1 million francs, dollars, there is incentive to really attack this and get it lost. Now, the government wants to, the US government wants to attack you here. They don't know who you are, where you bought these, and there is the idea that this old laptop put already a backdoor, which is Bitcoin ready since the 90s. Well, 90s maybe not, since the early 2000s, before Bitcoin is unlikely. So this is safer from the government, but not safe from the cleaning lady. Now, the other extreme is the opposite. Ledger has a secure element created by ST Microelectronic, which is a company which is Italian-French company. Ledger company buys chips from there with ledger on the order invoice. If the US government didn't create a backdoor in these chips, they are incompetent by now. They probably did already 5 years ago. It would be a firmware is completely closed source. NDA, Ledger is not allowed legally to disclose anything about the chip, and they are closed source under NDA. And if they are not in together, it's just STME. And even if STME didn't, there are many ways in which Ledger could. Also, since it was not scary enough, they decided to create a seed recovery function in which your seed will basically, your hardware will basically give the seed to the Ledger company. It's a help for the users for recovery. So now though your clean lady finds this, there is no way they can hack it. It's a secure element. It's from the point of view of physical attack by an unknown external party is super resistant. Government wants to take all your money from distance. They don't even have to bother to move. Maybe there is a giant still Bitcoin button in some place in France, and they just do like this, and they all get spent. Probably the many keys could be pre-generated pseudo randomically. I don't know that. This is a bold accusation. I'm just saying that if I was a government, I would probably do it. So bad for the government. Now, there are things in between. For example, a Trezor is basically before the new chip. The Trezor was just like a very small laptop. The Trezor doesn't have a secure element, so it's just a small laptop. Is safer than this from physical attacks because it's smaller, so it's harder to keylog to do stuff, but same security. The cold card, I would say, it's like a better ledger because they're buying secure elements from several different sources and not just one. And they are all the secure elements which are weaker individually, but all together they are also not under NDA at least. They are not open source, but there are several. So there is a spectrum here. What I would personally do is to match the spectrum. For high security, you do something like, let's say, 2 of 3, and you just put one of these, and one of these. Now it means that either they had to activate the button in France and compromise one of the provider of CoinKite, or they have to attack physically your computer and find a side channel, or one of the other combination. It's not perfect, but you are exploring the security spectrum in a nice way. If you have $10 equivalent, don't do this. The chance that you lose everything because you don't remember the setup is higher. But if you have more than 1 million, consider doing a multi-sig with different security models from different. If you're using this alone, I will advise against. It's very bad for privacy because the default tool, which is Ledger Live, will give your XPub with your IP to the Ledger company, and well, that's already pretty bad. I close this lecture with this. Bitcoin is based on 3 main privacy levels. Privacy level 1, keep your secret key secret. If you don't have privacy there, other people will move your Bitcoin. Privacy 2, keep the connection between your identity and your public key secret. Because even if your private key is secret, if your public key is connected with your identity, people will come to you with a wrench, and they will hit you until your private key is not private anymore. Level 3, keep your several different public keys disconnected among them as much as possible using Lightning and CoinJoin. Why? Because you will leak the connection with some public key eventually. It always happens. If your public keys are all trivially connected, you leak one, and now you infect everything else with your KYC or whatever. Instead, if you keep them separated, you leak one, and the attacker, the kidnapper, the fisher, they will only have access to your single key and not everybody and not every other thing key. Using a ledger for all your keys with Ledger Live is bad. If you use it with a good multi-sig setup with Sparrow, Spectre, it's good. Over. Thank you. See you somewhere next during the school.